9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
That's right. Happy Monday, everyone. Stock futures are in the green right now, looking to regain footing coming off of a shaky week for markets. But earnings remain top of mind for investors this week. A crucial test for the so-called Magnificent Seven this week with quarterly results from Tesla, Meta, Apple, and Microsoft, all on tap.
And that is not all. A fresh GDP print on Thursday and PCE, the Fed's preferred inflation gauge, that's going to be out on Friday. So let's get right to it with the three things that you need to know. It's your roadmap for today's trading day. Yahoo Finance's Madison Mills, Pras Subramanian, and Rick Newman have more.
Stock futures starting to tick into the green this morning as earnings season is ramping up this week. We've got big tech earnings on deck, a big test for the market strength after that tech-heavy Nasdaq dropping over 6% last week with that biggest sell-off in the so-called Magnificent Seven since 2022. We're going to get quarterly reports from some of those companies. Those include Tesla, Apple, Microsoft, and Alphabet.
Plus, the EV price war is heating up again, with Tesla and Li Auto slashing prices on their EVs in China to keep up with competition. Tesla also cutting prices in the U.S. for the Model Y and the Model X as demand woes persist into Q2, with the stock hitting fresh new 52-week lows. Shares of Li Auto are also falling more than 7% on its round of new price cuts.
And the House was busy over the weekend, passing 4 new bills. Lawmakers looking to authorize $95 billion to provide foreign aid to Ukraine, Israel, and Taiwan, while one bill would potentially ban TikTok in the United States. The bill that passed the House resembles an earlier version approved in March. All 4 bills now head to the Senate, with votes expected to take place in coming days.
Well, let's get right to it. Today's top story, futures right now higher ahead of a busy earnings week. Crucial test for the big 4 of the Magnificent Seven companies set to report: Tesla, Meta, Alphabet, and Microsoft. The group coming off their worst week on record. We're taking a look here at the Nasdaq Composite. I'll just give you a chart and the setup coming into this week, of course, as we're taking a look the past 5 days here. That's the setup, down by about 5.5%. But let's zero in on some of those mega cap tech stocks, Shauna, especially as we're gearing up for this earnings period and taking a look at the pre-market move. Let's just add that on top. Extended hours trading here. You're seeing a little bit of gains across the board for some of those mega cap tech stocks right now.
You are, and we were coming off what was essentially a bloodbath here for many of those larger cap tech names, especially the losses that you're looking at on Friday. So we had Nvidia dropping 10%. You had Amazon off just about 2.5%, Meta falling 4%, Netflix having the worst day that we have seen now in quite some time. And taking a look at the 5-day moves that we've seen in some of these larger cap tech names, you can see it actually gets even worse for a lot of these bigger names. You've got Nvidia coming off of a week where it fell nearly 14% here in the market. You got Apple off nearly 7%, Microsoft off about 5% last week. So that really puts some pressure on earnings, and whether or not earnings is going to be enough to really turn around this momentum here that we certainly do have to the downside. At least it looks like from reports that have been out over the weekend and the first look here at the street here this morning ahead of the bell, there's lots of questions about whether or not actually earnings are going to be enough to stop the losses that we're seeing in some of these larger cap names. And
just to put some additional numbers on this, of course, for the Magnificent Seven stocks, $950 billion in market cap lost last week. Largest weekly loss on record. That's according to Dow Jones market data here. And so let's just put that market cap figure on there as well as we kind of toggle over to that. Well, it's not going to do it in aggregate because I still have the extended hours on. But you get the picture here, especially with the percentage move that we've seen here. But here's one other stat, and this came out from FactSet late last week with regard to earnings here. In aggregate, the Magnificent Seven companies, 5 of them are expected to report year-over-year earnings growth of 64.3%. So all in for the first quarter. Excluding those 5 companies, blended, actual, and estimated results earnings decline for the remaining 495 names in the S&P 500. That's expected to be down 6% for Q1 of 2024. So where does that net out? just a net gain of about 0.5% for the entire S&P 500.
Yeah, that's great because it really puts everything in perspective here ahead of what is going to be an extremely critical week for the markets. Our next guest, though, saying that valuations for the Mag 7 remains elevated and that the correction we're seeing right now is normal. We want to bring in Troy Gajewski. He is FS Investments Chief Market Strategist. Troy, we're going to join you at the desk here in just a minute. But first, just your take on some of that selling action that we've been seeing in the markets right now. Why shouldn't investors be too worried?
Well, big picture, right? What is driving the sell-off? It's stronger economic growth leading to stronger inflation, leading to bond market participants pushing back the expectation for Fed cuts, which were somewhat delusional to start with. So there's really nothing disastrous in terms of fundamentals. Earnings growth looks significantly powerful. However, higher yield should mean lower multiples, which is what we're seeing now.
I tried to remember that stat from FactSet off the top there, but I needed my paper to be able to reference exactly what they were laying out there, Troy. And kudos to you, too. Unfettered concentration as we were making our way over to the desk here as well here. You know, as we're thinking about this earnings season, what is one huge theme that you expect to emerge?
Well, I think it's divergence, right? So you think of a lot of the rebound from October 22 to really end of last year, very concentrated in Magnificent Seven. You know, every company, for the most part, Tesla maybe an exception, was doing very well. And this year you've seen much more significant divergence, right? Apple, which has obviously been a juggernaut, hasn't performed as well. Tesla's been a borderline train wreck. But and then on the other side, you have Nvidia just monetizing, you know, the AI boom, which is something we've never really seen. In history, there really hasn't been a company like Nvidia that has grown market cap so fast, but has grown earnings faster. Really, really remarkable. So the divergence, that's a healthy development for markets.
Should investors be looking at some of the selling that we were looking at last week and seeing that as a buying opportunity? When you take a look at overall the Nasdaq here coming off what was extremely terrible week here, worst week that we've seen in quite some time, is that an entry point?
Yeah, I think you have to be a little careful in the short term because what's really driving markets again is the back end of the Treasury curve. And when you think of the limitless issuance that's going on, you think about the fact that inflation is persisting, it's very easy to imagine a 10-year breaching 5%. Remember, 5% was the limit we hit last year. So I think you want to be cautious in the short term. But when you look through the Magnificent Seven, you know, Nvidia is obviously a clear winner, Amazon, Microsoft. So if you missed the upside and you need to add more mega cap beta, that might be a good thing to start with. However, just be cautious, right? Because we could certainly fall another 5 to 10% in the Nasdaq here.
Interesting. Okay. And so how much of a catalyst, one way or the other, is the Fed and the decision making that comes now, not even just in June, but going into the third quarter of this year?
Yeah, so as usual, the Fed is the most powerful financial institution in the world, right? And you know, the interplay between Fed policy, money supply, Treasury valuations, always very critical. If the S&P was 16 times forward earnings, wouldn't matter as much. But we got back up to 21 times forward earnings, and even with strong earnings growth and a powerful economy, you can get multiple compression into elevated yields, which is exactly what we're seeing now.
So, Drew, what should investors then be doing if they need to be cautious on some of these larger cap tech names, especially here in the short term? What kind of changes or what kind of adjustments should they be making to their strategy, if any?
Yeah, well, look, I think the biggest challenge for investors right now isn't necessarily should they rotate more risk into the Magnificent Seven or mega cap tech. It's how to put those massive cash hoards to work that they've built, right? So you've built up over $2.5 trillion in money markets since the pandemic. T-bill ownership's off the charts. So one of the best things to do right now is look for alternatives you can embrace where you're meaningfully increasing your return without taking uncomfortable levels of risk, right? And by uncomfortable levels of risk, it was a reminder of the last 2 weeks that, you know, if you're adding risk at elevated valuations, you can walk into a meaningful correction. Who needs the volatility? If you can make high single digits or low teens, there are many democratized options now you can pursue.
Bitcoin, we got to talk about this for a hot second here. The halving taking place on Friday, the phenomenon happening roughly every 4 years, of course, the 210,000 blocks that need to be created here. I got to know, from your perspective, how much more of a tailwind that provides to some of the Bitcoin pricing now and how you're evaluating it.
Yeah, so classically, whenever you have new supply constrained, right, and demand stays constant, you get higher prices.
Right.
So, you know, Bitcoin's an incredibly cyclical asset. We'd expect more upside. The cautionary note, though, is it's unclear to everyone how much of that upside's already priced in because you had the ETF flows, the approval, the surge, and you already made new highs prior to the halving, which had never been done before. So from our perspective, we do expect further upside. However, you have to be cautious with volatility. Again, remember that term, uncomfortable levels of risk. If you can't tolerate a 10, 15, 20% drawdown, you probably shouldn't be invested in the first place. But I would be surprised if we're not at 50 to 100% over the next year.
When you talk about then that catalyst going forward, what is it going to be in order to get to those all-time highs?
So I think it's very dependent on whether ETF flows continue to be positive. Since ETF approval, it's almost been a perfect correlation. When there's flows coming in and the Wall Street marketing machine can attract new capital, Bitcoin goes up. When there's outflows, it corrects or goes the other way. So, it's very difficult to predict that, but you would think as there's more and more adoption, there will at least be enough flows to absorb new supply and then some, which will drive price higher.
And then additionally here, when we think about some of the other ETFs that could potentially be listed this year, do you think that there's any perhaps large difference in the number of people who are willing to flow into Bitcoin or continue to flow into Bitcoin versus the ETFs that have been put forward like Ethereum or some of the other altcoins?
Yeah, I think Bitcoin's very different because it's really got institutionalized last cycle, meaning there was always the ability to attract capital away from, let's call it, the crypto community. I think when you're talking about other cryptos, for instance, Ethereum, there's a lot of debate over whether Solana is going to eat their lunch or not. You have very disappointing performance so far in this cycle. And I just don't see the same degree of institutional adoption like you have with Bitcoin. Because ultimately, Bitcoin, it's hard money. It's an inflation hedge. It's a government profligacy hedge that more and more institutions are adopting.
Troy, great to see you in person.
Great to be here as well.
Thanks for coming in studio. Troy Gajewski, who is the FS Investments Chief Market Strategist. And a programming note that also involves Troy. Yahoo Finance launched our brand new podcast, The Opening Bid, this morning, bright and early, 8 a.m. Troy Gajewski joined our executive editor, Brian Sozzi, and talked all things markets and tech. Catch Opening Bid with Brian Sozzi every Monday and Friday at 8 a.m. Eastern. Well, switching gears here, Tesla shares falling again today after slashing prices of its Model 3 in China yet again here. The move from Tesla-led Chinese EV maker Li Auto to also cut prices on several of its models as the EV pricing war escalates. Shares of Li Auto also sinking this morning. Yahoo Finance's Pras Subramanian has the details. Hey, Pras.
Hey, Brad. Yeah, man. So there's definitely some price action here in China, but also in the U.S., right? So you mentioned China up first. You had Model 3 going down to about $32,000 U.S. So it was a pretty big cut here from 232,000 yuan to 246,000 yuan. So a big move there. Also the Model Y down to around 34,500 as well. Slight move down there. So like you mentioned, rival Li Auto also cutting prices. They're feeling yet that those concerns of a price war that even the government was concerned about because of the fact that these companies were sort of raging at each other. But also in the U.S., I want to note that the Model Y also went down by $2,000, the cheapest version now back down to $42,990. This is what it was before Tesla had hiked those prices shortly after Q1 ended. They also cut some of the higher trim level prices of the Model Y by $2,000 too, and the Model X also coming down. So this is all coming after both the moves in China and the U.S. after that disappointing Q1 delivery report. We also have earnings coming up tomorrow after the bell. Tesla is supposed to report a 40% drop in operating profit and its first revenue decline in 4 years. This according to Bloomberg.
And Pras, when you take that into account, and the analyst notes that you've been going through, how much? What's the sentiment out there just in terms of how much is that of that bad news has already been priced into the stock, given that massive underperformance that we've seen in Tesla since the start of the year?
Yeah, you would think that it has already been priced into the stock at this point, but and I don't know if we're going to get much of a surprise there from their forward guidance because they've been very kind of not so consistent or not so clear on where they think the 2024 deliveries will go. But I think, Sean, the big question is, what is the future of the sub $25,000 Model 2 vehicle, as they called it? Is it truly dead? Second question is robotaxi. How for real is it? Are we going to see a working model by August 8th, the reveal date, or will it be another sort of design sketch that we have no idea when that vehicle will come out? I think those two pieces of news potentially will be the big movers of the stock, beyond saying anything worse about the demand situation here in the U.S. and China.
Yeah, Pras, we were talking to Dan Ives last week. Also, Deutsche Bank came out with that note talking about the risk that if we have any sort of negative update on the Model 2, what exactly that's going to mean then for the price of Tesla, at least in the short term. All right, Pras, great stuff. Thanks so much.
Thank you.
The House passing several bills over the weekend providing aid to Ukraine, Israel, and Taiwan, plus one that could lead to a potential TikTok ban. The bills will now be sent collectively to the Senate. Yahoo Finance's Rick Newman has the details on that. So, Rick, what's next in the Senate?
It looks like it's a pretty good chance the Senate is going to pass these bills, and they might do it quickly because they're supposed to be on recess this week, so they want to get out of town. The Senate has already passed most of this. They've already passed the foreign aid, so it's coming back to them from a House in a slightly different form. Senate has not so far voted on a TikTok ban, but it looks like that is going to pass as well. So, I mean, the two things I would call out from this flurry of activity finally over the weekend. This is a desperately needed lifeline for Ukraine, which is massively outgunned by Russia. They just need ammunition, a lot of basic ammunition, and they're now going to get it, it looks like. The TikTok ban, I have to say, I'm very surprised that it looks like Congress is actually going to do this. Everybody should remember that the point is not so much to ban TikTok, but to actually force a sale so that the Chinese owner sells to a non-Chinese owner. But I saw in a note from Raymond James this morning, they said their base case is that the bill goes through, the TikTok ban goes into place, and that China actually refuses to divest, and TikTok stops operating in the United States in 2025. I mean, I find that stunning. And I have to wonder what kind of political risk there might be in there for President Joe Biden, who said he will sign the bill. He desperately needs young voters, and they're not going to like this. So this is going to be fascinating to watch as this develops.
Yeah, and some reporting from the FT this morning as well, Rick, saying that there was an internal memo and the legislation saying it's a clear violation of the First Amendment rights of TikTok's 170 million American users. That coming in a memo to staff from TikTok's public policy head. So we'll see how they are also gearing up to fight this as well in the near term. Rick, thanks so much. Appreciate it.
Hi, guys.
Well, we're just getting started here on the Morning Brief. Coming up, price hikes gave Verizon a boost in the first quarter. The company also capitalized on streaming bundles. We'll break down the earnings report after the break, and later on, the not-so-magnificent seven. We'll dive into the biggest tech names ahead of a massive earnings report week ahead. Plus, a programming note. Our new podcast, Opening Bid, launched on Yahoo Finance this morning. Catch our executive editor, Brian Sazi, every Monday and Friday at 8 a.m. Eastern to get you up to speed on the market action and the week ahead. We'll be right back.
It's a big week for econ data. Investors will be getting a closer look at housing, economic growth, and inflation, including the Fed's preferred inflation gauge, PCE. That's going to be released on Friday. To break it all down, we want to bring in Ludovic Subran, Allianz chief economist, is here. Ludovic, it's great to see you. So talk to us just about the importance of the econ data that we have on tap this week and what kind of insight this potentially is expected to give on the Fed's timing of the first rate cut.
Look, it's a very important crossroads, right? Because everybody is looking at the Fed, including us over here in Europe, because we wouldn't want to start cutting rates before the Fed, commits to it. So, of course, we're going to watch, whether the PCE can come notoriously down compared to its last reading, because that's a key indicator for the Fed. But also, we got to look at Q1 GDP numbers to understand a bit how much overheating is still in the U.S. economy, and that warrants a form of action from the Fed. So all eyes indeed on the week. I think you're just showing the 3.4% revised Q4 annualized data for the US, which was quite a strong read when you think about what was expected by consensus. Yeah.
If we get a hotter than expected PCE reading this week, how does that massively change the outlook for the Fed's rate cut pathway this year?
Look, if we get another PCE above 3.5 or 4%, the problem is we're going to have to delay the Fed first rate cut after the summer. And then you have elections. You guys have elections in November. So the problem is it's a catch-22, right? Can the Fed start cutting in September and then pause and then cut again in December to deliver 50 bips, which is what markets expect? Or do they cut 2 days after the election results? And I think you could say that if it's really dependent politically, you could do that. We expect it to cut in September. But it's true that it's quite far, already. And the benefits will be only visible in 2025. So it's a very political loosening cycle that is ahead of us, especially because especially candidate Trump is promising to reheat a bit the U.S. economy if he gets elected. So the Fed could actually be forced to stop halfway through the loosening cycle and have a very bizarre 2025 when it comes to the rate pathway.
Would that be a mistake if the Fed doesn't cut before the elections?
I don't think so. I think, personally, I think the U.S. is ripe for a cut right now. But if they didn't cut before, I think the only problem would be, I would be very concerned for market reaction, especially you've been talking in your show just before about the equity markets and especially what is expected of big tech. I'm worried about the debt market. I'm worried about high yield, and I'm worried about all these companies, but also these households, right, whose mortgage affordability is at stake. So I think the problem will be if the first cut is delivered into 2045, we would see very negative reading for growth, especially in Q4 in the U.S.
Yeah, Ludovic, talk to me a little bit more just about that risk that you see brewing within the debt market and exactly what that means for economic growth, and then essentially the trickle-down effect to why this is also a massive risk here for the markets as well.
Look, I believe, this cycle is very different, mostly because of fiscal policy, right? The 8% deficit explains, I would say, most of the absence of transmission of monetary policy to especially spreads in the investment grade and high yield segment. I think they are too narrow, to be honest, compared to the firm's financials. Some firms are actually doing very well and are still loading this cash, but there is still a huge segment of the market, 20-25%, I think, of the issuance that is at risk, that looks very zombified to me. And of course, if the Fed were a bit late to the cut, I think the refinancing will start kicking in. So 2025, 20% or so of some of these companies have to refinance their debt. So if they refinance at 5% or 6% or 7% instead of refinancing 100 basis points below, of course, that changes completely the game because they are already zombie companies where net refinancing costs are higher than their EBITDA. So I would be worried about some of them going belly up here.
Okay. There's kind of two prongs as well here that we also have to consider for the Fed. And the other side of this is employment. Where do you think employment continues to trend in the labor market more broadly, as we've seen some hotter than expected prints and then revisions kind of balance things out on aggregate? But at the same time, there's still the wage pressure consideration that could flow through directly to the inflation picture.
I think the labor market is to be frozen for the next 6 months because firms are going into wait-and-see mode. So there was a front-loading of the so-called IRA subsidies that were supposed to come. By the way, they didn't come as much as most firms were expected. So that was a bridge, and that caused a lot of labor hoarding. Now there is still good consumer data. So I think in the services, the leisure industry, hospitality, etc., the jobs numbers are good. But I'm expecting jobs numbers to, cool down significantly into H2. And of course, that would be also one of the trigger, I would say, or the confidence measures that the Fed will use to start the loosening cycle. The question here is mostly the terminal rate, right? Can the Fed deliver, 150 basis points by the end of 2025? I'm not sure that it can, actually. And that's the big question, because this is what it needs to cool down the debt market that I just mentioned.
Ludovic Subran, who is the Allianz chief economist. Ludovic, thanks so much for taking the time ahead of today's trading activity. I appreciate it.
Thank you for your time.
Certainly. Well, we're just minutes away from the opening bell on Wall Street and taking a look at some of the biggest movers today. That is right ahead of the bell and right after this break. Oh yeah, clapping and cheering about to commence to start off this new trading week here. Let's do a check of the market sponsored by Tasty Trade right after this opening bell from the New York Stock Exchange and the Nasdaq, as we're seeing two great groups and large groups at the Nasdaq of bell ringers. You got Hashi Corp ringing the opening bell there, and at the NYSE, Amplify ETFs and Samsung Asset Management. All right, so things officially kick off for this week. Big tech earnings coming through, plus some big econ data that we're going to be tracking as well.
Yeah, certainly. We're seeing a bit of a rebound, you can call it, the start of maybe a larger rebound playing out in the markets. At least that's what investors are hoping here, coming off what was a down week here across the board. But you've got the Dow opening the week up nearly 200 points. You've got the S&P up about 0.5%. You can see getting closer and closer back to that 5,000 level. And you've also got the Nasdaq coming off of losses of more than 5% last week, actually moving to the upside, up just around 0.7%. When you take a look at the heat map and some of the gains that we're seeing here across the board, when you take a look, at least in the percentage change for some of these larger players within the Nasdaq. Let's see if we can do it here.
There we are.
Right, you got it?
Here,
there we go. Percentage. All right, we got it. We're thinking on our feet here this morning. All right, you got many of these larger cap tech names moving to the upside. You got Nvidia up just around 2%. Amazon, Meta also up over 1%, as well as Google and Microsoft holding on to those gains. So it will be critical here for investors to see what the momentum here is in tech ahead of many critical earnings reports that we're going to be getting out later this week.
Yeah, it'll be amazing to see exactly what the tenor is that they can signal that perhaps gives a little wind to the sails to the rest of the S&P 500 for this earnings season. However, based on some of that facts, that data that we were laying out earlier for those other 495 companies, and yeah, I say 495 because there's really only 5 players that they're siding with in the Mag 7, as we're seeing a little bit of fall off or bifurcation at this point. We'll see exactly what that tenor is that they set forth and what could be the potential catalyst here moving forward.
All right, let's get over to Madison Mills. She's standing by at the big board with a closer look at some of the movement that we're seeing here at the open, Maddie.
Well, as you mentioned, we're already seeing a little bit of a rebounding after that record-breaking tech sell-off that we saw on Friday here. But I'm going to focus on the commodity space, specifically starting with an alternative asset in the space. We're talking about Bitcoin here. And the Bitcoin halving that we saw happen over the weekend was highly anticipated, a big question mark as to whether or not that halving was going to have a huge impact on Bitcoin. Not so much, as you can see, up a little over 1.5% in the day here over the weekend, adding about $1,000 to that top line number, hitting over 66,000, which is a big deal considering that they went into the halving at 64,000. The big question being, what will the next catalyst be for Bitcoin moving forward? Because maybe that halving was already sort of priced in, given the record-breaking rally we saw in Bitcoin throughout the course of this year. I do want to flip the board over to take a look at oil for a second, because the WTI trade has been highly watched by investors because of the growing tensions in the Middle East. This is a little bit of a wonky board here, but you can see that oil was hitting closer to $85 a barrel, then briefly hit over that on Friday, obviously hitting below that 82 trend line. As we start off the week here, WTI down a little over 1%. The kind of narrative growing on the street is that maybe there was a mispricing of that the geopolitical tensions are easing, but be careful about that, because other folks that I've spoken with this morning, sources on the street, are saying that it's actually about the fundamentals when it comes to oil. We're seeing OPEC plus cuts, then the U.S. releasing some of the SPR potentially moving forward. Those fundamentals are what will drive oil moving forward. Lastly, I want to take a look at gold. Gold also easing as we enter this week. We're seeing that potentially that could be an indication that we're getting a little bit more risk this week as we see people putting money back into tech ahead of those big earnings.
All right, Maddie, thanks so much. Teeing up the rest of today's trading session for us and what to watch going forward from here. Here's some other ticker symbols to watch as well, some of our trending tickers on the Yahoo Finance platform. Ticker symbol CRM. Let's start there. Salesforce shares rising higher after the company's talks to buy Informatica cool after reportedly struggling to agree on deal terms, according to the Wall Street Journal. Informatica announcing on the back of this report that it is not currently engaged in any acquisition talks. Shares of Salesforce moving higher. Informatica, last I checked here, the company does report earnings May 1st. So next week, we're going to be hearing even more so about what the vision, the future looks like for this company, sans an acquisition.
Yeah, exactly. And we did see Informatica shares, at least initially on the heels of that first report coming out from the journal earlier this month, right around April 11th, April 12th, I believe. We did see that move to the upside here for Informatica, with shares touching the highest that they have reached now in quite some time. So we are seeing a bit of a pullback here from those elevated levels, something you would expect, obviously, following an update like this. But again, Informatica saying that there is no truth, at least right now, to the fact that they are in discussions to potentially be acquired. I also think it's interesting to talk about what this means here for Salesforce, because we did see, following that initial report that I was just talking about, we did see Salesforce shares under pressure. Because if Salesforce had been pursuing Informatica, it would have been a bit of a reversal from some of that restraint that they have shown here in recent quarters. They have certainly readjusted their potential acquisition plans going forward. They weren't so much focused on M&A anymore. They were focused on profitability, something that many of activist investors have been pushing for, and the street really liking that shift. So any sort of update in the fact that they were going to be pursuing Informatica, that then would have been a shift to kind of the old regime and how Salesforce have been approaching business deals over the last several years. So again, we're seeing some relief on the street. The fact that Salesforce, at least for now, seems to be remaining disciplined and focused on profitability, not so much those larger acquisitions. And as a result, you're looking at shares up just about 2.5% today.
Yeah. Informatica has a market cap of about $9 billion, so just shy of $10 billion there. You think about what this deal, if it had gone through, and the type of premium that Salesforce may have been pressed to slap on top of it, it would have been in the ranks of some of, and of course shy of the Slack acquisition that was, what, $27 billion a few years back, and Slack being a household name. Sure, makes sense to pay that much for a company in Slack, but Tableau, you think about that one, that was about $15 billion. So this one, with a premium slapped on, probably would have been somewhere in the ballpark of $11, $12 billion. And that's just on an average premium that you typically see for many of the acquisitions, especially as companies like Salesforce, like SAP, like Oracle have this history and propensity to acquire to grow instead of investing heavily to build something homegrown. If they've already seen success within a competitor in a landscape that they want to get into, they'll just, if they can, go out and buy it and hope shareholders don't push back on it here. So perhaps there was a little bit of the thinking that shareholders, if this price got too high, would push back on this in a big way.
Yeah, exactly, especially given the fact that Informatica, at least ahead of that report, have been climbing pretty steadily here since the start of the year. All right, another big mover for us is Verizon, the telecom giant, reporting mixed results in its first quarter, but lost fewer postpaid phone connections than expected, losing 68,000 as opposed to the 100,000 that analysts had anticipated. So better than expected results there. The company also saying that it is on track to meet its financial guidance and to deliver positive consumer postpaid phone net adds for the year. And that line is really what the street is excited about here this morning. You're looking at gains of just about 1.5%. I also want to point out that in their consumer segment here, that turned in its best first quarter performance that we have seen in 2018. So certainly Verizon highlighting some of that positive momentum that they are seeing within those businesses in areas where they had struggled amongst the rivals, really trying to retain their wireless consumers, because we know many of their competitors have been out there with promotions that made it even tougher here for Verizon in this environment.
Yeah, I sum this up as better than feared, and ultimately you hear some of the commentary from Verizon Chairman and CEO Hans Vestberg as well, saying that they're on track to meet their financial guidance and deliver positive consumer postpaid phone net adds for the year. So kind of reaffirming what they had already laid out. However, within that business segment, I think for the 20% of the revenue base that brings in, there is a little bit of a head scratcher that still emerges. Decrease of about 1.6% year over year in the revenue, as increases in wireless service revenue were more than offset by decreases in wireline revenue and wireless equipment revenue, they say here. So perhaps they'll be able to give a little bit more color, shed a little bit more light on that B2B side of the business. But that is one area that I imagine an analyst is going to be right to ask a few questions to Verizon executives on the call.
All right, Brad, let's get to a DJT, because the volatility continuing for Trump Media shares falling in the pre-market as the stock's roller coaster ride continues. The company was valued around $2.9 billion at Friday's close, and the former president is set to receive an additional $1.3 billion in share awards. Now, this comes after Citadel called the CEO of Trump Media a proverbial loser following Devin Nunes' letter to the Nasdaq. And this name, it's been surrounded obviously by opinion. Clearly from the street, people are not shying away from sharing what they think about what has certainly been a volatile run here for Trump Media ever since that agreement had been closed several weeks ago. We had seen a run up. We are well off those highs that we saw shortly after that merger had been completed. It has attracted a lot of attention from the retail trader crowd. And once again, you're seeing even increased volatility surrounding this name at the open for at least today and right now. Now, anything can change with any stock, but especially when you take a look at the volatility within Trump Media shares right now opening off just about 2%.
You know, a lot of what we've seen for Trump Media and Technology Group and ticker symbol DJT has really been more annexed to some of the people who may just be fans of DJT rather than those who are actually digging into the financials of the company and looking at the prospect for this business actually taking market share away from some of the other either large social media players or from the other large streaming giants right now who are offering ad-supported tiers, or on the social media side and the duopoly that has been for so many years between Alphabet and Meta continuing to entrench themselves. Oh yeah, plus Amazon, Apple adding on significant advertising conversion pitches for a lot of the advertised and marketing campaigns that are moving forward. So at this time, you got to wonder, how much of that would DJT actually be able to take away from the behemoths that are out there that we're expecting to hear from this week? And then on the other side, what is this then more than just another way to cozy up to some of the existing fans that will maybe buy a hat, maybe vote, and then now maybe vote with their dollars and invest? But a larger question of where perhaps there's some mimetic tendency within the trading around this name too. Also, everyone, the EV wars, the price wars, they're heating up, as you could expect. Tesla and Li Auto both slashing prices in China. Shares are both tumbling in early trading here. We've got more on this next. Tesla slashed prices in China again. Shares now down over 5%, declining for the 7th straight day. Last year, China became the world's largest auto exporter with over 5 million sales overseas. This according to the China Passenger Car Association. With 25% of those exports being new energy vehicles, many analysts are wondering if the United States is beginning to lose the EV war. For more on this, let's bring in Stephen Dyer, who is the managing partner and head of the Asia Automotive and Industrials Unit at Alex Partners Shanghai. Thanks so much for taking the time here with us. First and foremost, you think about the competitive landscape and how that is continuing to move about with some of the pricing moves. Why do you think all of the manufacturers are having to announce some of these price moves, and what is that saying about the consumer right now?
Well, it's great for the consumer. There's been significant overinvestment in the Chinese EV sector over the years as the government has supported the build out of that sector. So now we're seeing some of the chickens begin to come home to roost, so to speak, as firms are trying to gain share and gain market share and credibility with their brand.
Stephen, do you think this is likely going to spark even another round of pricing cuts? And I guess, what is the reaction there on the ground in China and the likelihood that this is really going to spur more demand than going forward?
Well, I do think there will probably be further price cuts, and it's an ironic situation that goes against the normal microeconomic expectations. So in China, when companies cut prices, in this case, many consumers say, let's wait and see. We don't think it's at the bottom yet. And so it interestingly hasn't sparked the demand that we would normally expect when you cut prices.
Stephen, as you look out into the kind of consumer sentiment around foreign names that are trying to sell cars in China and some of the investments that they've made to make sure that they're ramping up the production at the same time where demand may be shifting to some of the more kind of nationally produced names there. How does that impact some of the U.S. companies that have ambitions to grow out their own ability to communicate, to continue to have a relationship with the consumer in that region?
Well, certainly the Chinese automotive brands last year and continuing this year have been big winners in both the China auto market and globally, becoming the number one export country. And the reasons for that are that some of the Chinese EV brands are much better at listening to the consumer and delivering the advanced technology, the infotainment, intelligent cockpit, as well as driver assist technology that at least Chinese consumers want, and not focusing so much on the very difficult to achieve ride and handling and noise and vibration specifications that are traditional automakers' forte. So it does not bode well for global automakers in China, and so there's some catching up to do, I think.
Stephen, when it comes to the future of Chinese automakers here around the world, specifically in the U.S., when you take into account what current President Biden has been saying about potential tariffs here, what former President Trump has been saying about tariffs if he is reelected in November, how big of a challenge is this for Chinese automakers, and what are they doing, or what do you anticipate they will do to navigate what is going to be an uncertain and potentially a hard time here for those companies?
Yeah, indeed, the geopolitical winds are blowing against the Chinese automakers and even suppliers, and they realize that. They have they understand very well, and therefore North America is probably not going to be their short-term target as they grow globally. So Europe and other more emerging markets are the short-term target for exports, and then even establishing assembly bases. I would expect North America to be the last on their list of priorities.
Can pricing alone save some of the waning demand that we're seeing for EVs right now, Stephen?
Well, in China, as I mentioned, it's caused the ironic result that demand is stagnating for EVs until the prices hit the bottom. So when they do hit the bottom, certainly it'll stimulate demand, and especially in the U.S. and North America and Europe as well. These markets, according to a recent EV consumer survey that AlixPartners conducted globally, indicate that consumers there are also hungry for inexpensive EVs that will allow them to save on operating costs as well as initial purchase or lease cost.
Stephen Dyer, we'll leave it there. Thanks so much for hopping on with us here this morning, head of the Asia Automotive and Industrials Unit at AlixPartners. Thanks, Stephen.
Thank you.
Coming up after the break, more on the latest Bitcoin halving and how Bitcoin miners are reacting so far, whether or not it's a smart investment opportunity. We'll talk about that next. Bitcoin completing its halving on a Friday. Now the process that happens every 4 years. Take a look at the price of Bitcoin and some of the reaction that we're seeing play out this morning. We're actually seeing prices move further to the upside, now above 66,000. Now, one of the big questions, though, that remains is the effect it's going to have on the business for Bitcoin miners themselves and that pressure that could look like here for revenue, at least in the short term. We want to bring in Michael Shalev. He is the CEO of Fireblocks. Michael, it's good to have you here. So talk to us just about the price action that we've seen in Bitcoin miners, because they're actually holding up better than many had feared as a result here of this halving. So what's going on?
Yeah, thanks for having me. Basically, what we're currently seeing is that the activity of the Bitcoin network just continues. What we're hearing, so we're basically servicing some of the Bitcoin miners from a custody technology standpoint. And what we're hearing from them is that they continue to invest. They actually think that they're going to be compensated on the halving, the fact that they're now getting half of the price. And I don't think we are going to see the market sort of dropping, at least this is not what they're expecting.
What is the expectation for the prices that Bitcoin miners are expecting to have to factor in to their expense base now?
Yeah, so just to maybe take half a step back, basically the way that Bitcoin miners getting their rewards, there are two parts to it. The first part is that they need to solve a puzzle which basically secures the Bitcoin network. And the second part is basically the fees of the people that are doing the Bitcoin transactions, what they're willing to pay. So after the halving, basically the first part of getting rewards for solving the puzzle, that was dropped by half. And therefore, what they anticipate is that the Bitcoin prices will continue to rise, so they will be able to continue and buy the energy that they need to operate the network.
Michael, when you take into account some of the things or some of the changes that crypto miners are undergoing right now, I've been seeing more and more headlines talking about the shift to AI and how they are employing AI to offset some of that increased cost. Can you talk to us a little bit more about what that opportunity looks like and I guess the benefit that this will ultimately be here for some of those miners in the longer term?
Yeah, I think that there is a narrative of using the same compute that is being used to operate the mining. So, for example, some of the Nvidia cards and allocate some of that to AI workloads. But right now, with the prices that we see in terms of Bitcoin, this is still quite profitable for the miners. So it's not clear that if that shift to AI is something that is actually a hedge, assuming that the Bitcoin activity will become less profitable. It's definitely not something that we're seeing right now.
Michael, there's a new protocol here as well that's come along with this most recent halving. And I think we're trying to kind of wrap our heads around exactly what that means going forward from here, especially for a lot of the potential Bitcoin investors called runes, I believe it is. And so, I mean, does that change how people should be thinking about Bitcoin, about the problem-solving equation and the mining process at all? Or is this just something that was to be expected coming along with this halving?
Yeah, so as part of what we were seeing in the last year with Bitcoin, we started to see NFTs, basically non-fungible tokens, something that we've seen in the previous cycle. And that activity has sort of started to become somewhat popular on Bitcoin. That actually creates a lot of activity on the Bitcoin network, where essentially people need to pay fees, right, to operate that protocol. And therefore, the miners are able to gain or basically get some of the offset from the halving from that new activity.
Michael, what do you see as the biggest near-term drivers of the crypto price action?
Yeah, I think that what we are about to see is that with the Bitcoin ETF coming in and some of the regulatory clarity that we are starting to see on the global scale, we'll start seeing more and more players that are able to offer access to a bigger investor base. So essentially both retail and professional and institutional investors. And that will probably what would start driving the prices up, both for Bitcoin and other cryptos. For other cryptos, especially for protocols like Ethereum, Polygon, Solana, and so on, we're actually seeing real utility in terms of payments, Web3, royalties, and things like that, increasing the adoption. And therefore, those are much more mainstream activities that are going to drive the prices of some of those protocols.
All right, Michael Shalov, CEO of Fireblocks. Great to have you here this morning. Thanks so much for your insight.
Thank you so much.
Coming up, Madison Mills will be joining me here at the desk for the next hour. A couple of big headlines that we're going to be taking a deep dive into. First, the EV pricing war that's playing out right now in China. Second, that huge tech sell-off that we saw last week. We'll take a look at the Magnificent Seven, the performance, and what that signals here ahead of what is going to be a crucial week here for the sector and the broader markets. Taking into account over half of the Mag 7 stocks are set to report their earnings here this week, Brad.
I'll be tuning in. I'll also be back at 11 a.m. Eastern for our new show, Wealth. We'll dive into whether you should hold Bitcoin in your portfolio after the halving and whether you should consider recent EV price cuts when making your next car purchase, plus the rental market. We're going to discuss all that and much more. Stay tuned. This is Yahoo Finance.
Welcome back to Yahoo Finance. I'm Shauna Smith alongside Madison Mills. We're 30 minutes into the trading day. Let's get right into it. Today's top stories. First up, stocks are rebounding after the tech sell-off as investors are set to digest a tidal wave of earnings this week. 178 of the S&P 500 companies are reporting, and that includes leaders in big tech, autos, consumer staples, energy, and travel.
And Sean, a lot of attention will be on those big tech earnings. Of course, we've got Tesla, Meta, Microsoft, and Alphabet all reporting their latest quarterly results this week. It's expected to be a crucial test for markets, particularly following that sell-off we just saw. Investors are going to be watching to see if the Mag 7 can reignite an AI-fueled market rally.
And Tesla is wrapped up in the latest EV pricing war that's playing out in China. The automaker cut prices on its Model 3 in China by nearly $2,000 as its competitors in the world's second largest economy also slashed prices. Li Auto trimmed its prices on several of its vehicles, and the shares of both of those companies are trading in the red here this morning. We're going to dive deeper into that story later this hour. But first, we got to start with the sell-off that happened in tech this week and talk about what exactly that means for investors today, because it is a crucial test for the markets. We've got big earnings on deck when it comes to the big tech sector. 4 of the Mag 7 companies are set to report. Tesla, Meta, Alphabet, and Microsoft are all on tap. Now, this group coming off of one of its worst weeks, or its worst week on record. The Mag 7 combined to lose $950 billion in market cap, and that's according to the latest data out from Dow Jones Market. So here to talk about this is Josh Schaefer. Who better to ask than what exactly this means here for the market? But Josh, just walk us through some of these projections, the estimates that we're expecting to hear from tech, and why when you see weakness like we did last week, obviously it's extremely concerning here for the broader market.
Yeah, Shauna, we went through a lot of stats there, but I'll give you one more. I'll pile on a little bit. I found this stat from Ryan Dietrich over at Carson Group pretty interesting, and it sort of puts tech in perspective for us. More than 300 stocks in the S&P 500 were in the green on Friday, yet the index was down almost 1%. And when you look at what stocks were down, you just mentioned them, but Nvidia falling 10% matters a lot to this market, and it matters a lot to the indexes. This week specifically, we're going to be looking at different tech companies other than Nvidia, the other big companies, Microsoft, Alphabet, Meta, and the expectations are really pretty sky high here. So when you look at the group of 5, we'll call them, I'm not going to give them some fancy name, but I'm using the Mag 7 stocks. You take out Tesla and you take out Apple, those 5 stocks are expected to grow earnings 64% this quarter. That's according to FactSet. When you remove them, the other 495 S&P 500 companies are expected to see earnings decline by 6%. So really, the large portion of S&P 500 earnings growth that we're hoping to see this quarter is just 5 stocks. It's really just still these 5 stocks, and you're going to hear from several of them this week. You're going to hear from Meta, from Microsoft, and from Alphabet. And I think it's important for them to not only maybe meet sort of where these high expectations are. To give you a sense, too, of how high these expectations are, Meta's expected to grow earnings by almost 100%. Wow. That is not an easy print, right? Those expectations are very high, and we've seen the market react thus far to earnings season, where even if companies are able to meet high expectations, if they're not able to guide something higher too, it hasn't necessarily brought good stock reaction. So I think that will be one thing to watch certainly later this week, is just what sort of reaction we see. Also the commentary. When we think about the rally and sort of how we got here over the last year, it's been about AI, right? What can these executives say about AI that either reassures people or brings some concerns about where we're at in that investment process, if it's actually contributing to earnings?
Yeah, well, it's interesting because I'm looking at this note we just got from Bank of America saying that geopolitical shocks in particular should be bought and not sold. But there's this narrative in some of the notes that the rebound that we're seeing this morning is because the geopolitical tensions didn't bubble up over the weekend. And I don't buy that that's the reason. I think people saw that Nvidia was a little cheaper and they wanted to get in.
Yeah, no, I mean, it down 10%, having its worst day in 4 years, right, going back to March 2020, I think definitely has some people saying, okay, let's take out my shopping list and sort of see where, because a lot of people could argue for a stock like that, the earnings growth is still there, right? It's supposed to be still there. And I guess that's sort of what the test is this week, is we've priced in this aggressive earnings growth for a lot of these tech companies. Are we going to actually see that? And are they going to talk about that coming down the pipe too? I think specifically about a company like Microsoft, who hasn't really had AI transfer into actual revenue yet. They've sort of been telling investors later this year is when it's going to be expected. But when you think back to earnings for the last couple quarters for them, they haven't really had AI surprises that have been to the upside in a very positive way. Meta has, but Microsoft really hasn't. I think it'll be interesting to see what we hear.
Yeah, and it's also so interesting because when you look inside each company, I mean, it is a very different story, right?
Yes.
It's tough to compare Nvidia to really any of the other Mag 7 names, just given the tremendous amount of growth that they have seen consecutively now for many quarters in a row. And then when you talk about kind of those longer term projections, like where Nvidia is going to be a year from now, I think that's where it's really going to get interesting, listening to some of the commentary that we'll be getting later on this earnings season. But I think it's going to help put this AI discussion kind of in place right now and make it a little bit more realistic to how much of this optimism has likely already been priced into the market.
It's a big week for Nvidia because who buys their chips, right?
Yeah.
It's these companies that are reporting this week that buy their chips. So if you want to have a little bit of a read through on where their demand's going to be, a large portion of that demand comes from these hyperscalers in Alphabet and Meta, right? Are they going to buy more? Are they investing more? And so it sort of is, I would argue, a pretty monumental week for the AI story and where it's headed.
Yeah, and then many of those names are going to be making their own chips, so then you can get into what exactly it means for NVIDIA then.
We got to make our own chip.
Oh, absolutely. I mean, let's
put
get
that on
Yahoo
the list.
Finance.
Let's put that on the list. Yahoo Finance chip coming soon.
Your next big assignment, Josh. Thank you so much for joining us, as always, for that primer on the tech sell-off and rebound. Really appreciate it. Speaking of that rebound from tech sell-off, Treasury's on track for their worst month so far this year following that sell-off, and investors are eyeing 3 bond auctions coming up this week. The demand for those auctions is going to be closely watched because that could be an indicator of investor sentiment this week ahead of key economic data releases, including PCE. Our next guest warns that the path forward for the Fed is only going to get harder from here. So we're going to speak with Tom Porcelli, PGIM's fixed income chief U.S. economist. Tom, thank you so much for being here. I mentioned those bond auctions coming up this week, but I'm curious, for the past 3 weeks, we've seen that the 10-year has been higher, the 10-year yield has been higher than the S&P 500 earnings yield, which has been driven by the Mag 7. What is the bond market telling us about that Mag 7 driven rally? Is it telling us that it's starting to stall off here?
Yeah, so thanks for having me. Good to be with you all. Yeah, look, I think what the market is telling you, what the bond market is telling you, is that we're in price discovery mode. I think the market is really trying to get a better sense for what higher for longer means in the context of a Fed that now may not cut this year. So I think, you're probably going to see some volatility. I think, you highlight auctions. Sure, I think there could be some volatility around that. I think the data will always cause some element of volatility. But I think ultimately we're really going to be taking our cue from the Fed as it relates to treasuries. And look, I think the hurdle is growing higher for the Fed to cut rates this year. And in a lot of ways, I feel like my view has become sort of bimodal. It's like I either think they're going to go 0 times or I think they're going to go a lot. I actually don't think they'll raise, and we could talk about that. But I think this is what the market is trying to figure out.
Tom, so what does it exactly mean then for the market if we don't see a cut before the end of the year? What kind of volatility could that ensue? And then as you look ahead to 2025, where does that leave your expectations there?
Yeah, it's such a great and important question because I think, look, we all seem to live in like a snapshot of time, right? And so you'll look at like a payroll report or you'll look at a PCE report, which we'll get on Friday, and say, oh, things look good. And I don't doubt that, right? I don't think I don't doubt for a second the snapshot in time is that things will look pretty good. And I think that might persist, certainly even over the balance of this year. I think the real challenge, though, comes in 25, because I do think that the reality is rates are in pretty restrictive territory. You are starting to see some early signs that there is some sort of, stress starting to build in the labor backdrop. Again, I want to stress, yes, I get it. We're printing 270,000 jobs. What I'm saying, labor or forecasting anything requires that you sort of drill deep. And so I do think that there are some signs that things are starting to slow down to some extent. And what I would stress is, when I look at the consumer in particular, what we have to keep in mind is the consumer is the only way the consumer's been able to drive consumption is to really drill deeper into saving. I mean, they're really using saving to support current consumption. And of course, using credit. These are not totally sustainable. So what I would argue is as you roll into 25, I think things start to look a little worse, particularly if the Fed has not cut rates.
Given that and given the timing of an election coming up, does that sort of force the Fed to either cut in June or have to wait until at least the end of this year?
Yeah, this is a really important question, too. And what I would say is this. Yes, history is littered with examples of the Fed adjusting policy around an election. But what I would also say is when the Fed has adjusted policy around an election, there's been an overwhelming reason for them to do it. Right now, I would argue it's probably going to be pretty debatable. And I think in a debatable backdrop, I think the Fed would want to veer away from adjusting policy. So I think you're quite right. if you don't get the string, right, like Powell keeps on saying he wants to see a string of good inflation reports, that will push the July cut, which they could potentially do, way out to December. Because I think, again, around an election, unless it's an overwhelming an overwhelming reason for them to cut, I think they're not going to be able to go in September and November, so that would push it out to December.
Tom, talk to me just a little bit more about that and exactly what it would take in order to justify some sort of move surrounding the election.
Yeah, I think it would basically take not just inflation really sort of softening up here, which again, we do think will happen. It's just not going to happen in a linear way, right? It's like you're not going to get month after month of improvement. There'll be a couple of months where, it's sort of seemingly the improvement is stabilizing. So I think it's not just inflation. I think it's labor at this point. I think you would really need to see labor start to slow down. We do think that by the end of the year, you could certainly see a higher unemployment rate. But it's going to be the combination of labor and inflation that I think would get the Fed to go in September and November. But again, I stress, I think that hurdle is growing increasingly higher for that to happen.
And given that, I wonder what you make about the shift in the hawkish versus dovish tone that we've heard from Fed officials. I'm wondering if Powell sort of started off the year sounding a little overly dovish so that he could hedge any potential pushback about when he may be cutting surrounding the election. What do you make of that?
Yeah, I mean, look, they're at the mercy of data. And again, this is a really important point. You cannot, it's arbitrary to say that you want to see a string of better inflation reports, which again, I think most people assume to be 3. That all seems pretty arbitrary to me. I think you have to have a view on inflation. And I think the Fed's view that inflation will continue to slow down, I think is quite right. I think the view that the unemployment rate will continue to sort of drift higher, right? And we're not talking about things falling off a cliff here. I think that view is also quite right. And I think if those are the views that you hold, then I think it's very reasonable to want to take back some of the aggressive tightening that the Fed has put in place. I think if that was your framework, I think that it would be very easy to make the case for cuts this year. And interestingly enough, that is the Fed's framework as of right now. But I think they're being swung around by single monthly data points. And look, I get it. The prior month number was pretty firm too. But again, I think it's the preponderance of data continue to suggest that you will see this continued slowing in inflation. But I think the Fed is very worried about credibility. I think that they've really sort of staked their view on we need to see inflation moving in the right direction. And because it's not going to be linear, I think that does create the improvement will not be linear. I think that does create a higher hurdle for them to cut.
Tom, I'm curious, before we let you go, we got to talk about the soft landing versus no landing debate that's happening right now. And it seems like when you take a look at the surveys, when you take a look at a lot of the recent notes that have been published here over the last several weeks, investors are increasingly starting to expect this no landing scenario. How likely is that? And then ultimately, it's got to land at some point, right? So then does that raise the odds of a soft landing or actually a hard landing?
So let me tell you, I hate the landing idea. It's too much. Because you don't really ever fully land, right? In fact, I would say if you want to keep it in aeronautical terms, then we operate at different altitudes from an economic perspective, and we have been operating at a very high altitude over the prior couple of years on the sort of in the wake of the post-pandemic period. Where now the altitude is now slowing. Again, slowing from a pretty high pace, but we think that economic activity is slowing. So that to me is a totally reasonable and fair way of thinking about the backdrop. But as I said earlier, the risk will grow for sort of a much slower economic activity or backdrop. The higher rates stay here.
Tom Porcelli, it's always great to speak with you, and I'm with you on that whole no landing scenario. The landing, way too much has been made of it, but we got to ask you about it because that is what the people want to be talking about right now and want to know exactly how it's all going to play out. But Tom Porcelli, PGIM's Fixed Income's Chief U.S. Economist, thanks so much for joining us here this morning.
Thanks.
Well, switching gears, the EV pricing war is heating up in China. Shares of Tesla now sinking this morning, and China's Li Auto falling to an 11-month low after both companies cut prices. Joining us now with the latest on this is our very own Akiko Fujita. Akiko.
Good morning to you, Shauna. Yeah, it certainly felt like a race to the bottom, if you will, in the world's largest EV market. That latest price cut coming through from Li Auto applies to 4 out of the 5 models for the car maker. We're talking about roughly 5% of the existing sale price, so about $4,100 off of what it's selling for right now. That comes one day after Tesla slashed prices for 4 of its models sold in China. Just for some context here, the Model Y is now selling for $34,502 roughly. Compare that to $42,990 in the U.S. That's the starting price for a Model Y here. So we're talking $8,500 roughly price difference between what's being sold in the U.S. as well as China. Now, this is just the latest in an ongoing price war that began all the way back in October of 2022. If you'll recall, that's when Tesla fired the first shot slashing its prices. Since then, nearly all of China's car makers have followed suit here. BYD has been among the most aggressive, slashing prices by more than 7% since the beginning of the year. Just last month, they slashed the price of its most affordable EV. That's the Seagull, now selling at $9,670. We're talking about less than $10,000 here. More than 30 of those brands have slashed prices in the first 4 months of this year alone. Now, the question is, what does the demand look like in China moving forward? On that front, we got a bit of a milestone over the weekend here. Data coming through from the Passenger Car Association showing that new energy cars surpassed ICE vehicles in China in terms of new car sales. So we're talking about the numbers here. That made up over 50% of car sales in the first 2 weeks of April. And yes, it's just the first 2 weeks of April, but that points to an overall trend that we have been seeing in China here. So 50% adoption, you compare that with 10% in the US. That's a significant number here. The data shows overall car sales were down about 11% year on year, but new electric vehicles, which includes battery electric vehicles as well as plug-in hybrids, increased 32% year on year. Now, we're talking about China, of course, because it is the largest EV market in the world. If you look at where the market share is globally, China makes up more than 55% of overall global EV car sales. Those are numbers from 2023 coming through from Canalys. But the state planner over in China today saying you can expect the price war to intensify because the sheer amount of cars that are in the market. And that's been a big concern, not just in China, but over in Europe as well as in the U.S. A statement coming through Monday from the National Development and Reform Commission says they expect more than 110 new energy vehicle models to launch this year among the 150 new vehicles that are debuting in 2024. The NDRC, said they expect market demand for these new energy cars to grow by 2.1 million units this year. Seems like a lot, but that's a little lower than what we have heard from the major car makers, including BYD. They were expecting combined deliveries about 2.3 million units for 2024. So guys, bottom line here, expect the price wars to continue because more and more EVs are coming online in China.
Doesn't sound like we're anywhere close to this EV pricing war being over or hitting a bottom there, Kiko, given the number of new models that you were just talking about there, and given the fact that it seems like we're still in this race to the bottom at this point. Kiko, thanks so much. Well, coming up, we will take a closer look at some of the big moves that's happening right now. Again, we are just about 50 minutes into the trading day. We're still looking at gains across the board. We've got the Dow, the S&P, and the Nasdaq all moving to the upside. You've got the Dow up just over 100 points, the Nasdaq up about 0.6%, a bit of a bounce back here from some of the selling action that we saw last week. We'll be right back.
We're going to do a markets check here, sponsored by Tasty Trade, taking a look across the major indices, seeing green across your screen. The Dow Jones up about, 83 points this morning there. The S&P up almost 0.3%. The Nasdaq up 0.3% as well. And this coming, of course, after that big tech sell-off that we saw last week. But this week, we've got 4 of the Magnificent 7 members, including Microsoft, reporting this week. But first up, we've got Tesla here. The S&P's value little changed this morning, but inching closer to that key 5,000 level after that sell-off that we saw last week. And again, just seeing that Tesla, they're struggling ahead of their reporting tomorrow off of those price cuts that we saw out of China, combined with some news of continued layoffs overnight. The name is down a little over 3.5% in the morning trade here. Alphabet, though, up about 0.8%, and Apple up 0.3%. Shauna.
All right, well, stocks are in the green as earnings season ramps up. A batch of big tech earnings from the likes of Tesla, Apple, Meta, and Alphabet will test some market strength after the tech-heavy Nasdaq dropped more than 5% last week, with the biggest Magnificent 7 sell-off since 2022. So since 22 here. But we have a long, busy road ahead of us. So is the tech truly the sector to watch this season? For more on corporate earnings, we want to bring in Chris Watling. He is Longview Economics CEO and Chief Market Strategist. So talk to us just about where things stand right now, right? We're coming off what was an extremely tumultuous week here for the market. You had the Nasdaq off more than 5%. That selling action that we've seen, is that over or is more likely to happen here going forward?
I think we're probably going to get more. I mean, interestingly, most sell-offs, most sort of corrections, most of them are pretty healthy. They're good things for the market, so we shouldn't be too dismayed as long as it's not driven by a big macro shock. But most market sell-offs, you get a wave flush down, then you get a bounce, and then you tend to get a bit more selling. So I think that's probably the playbook we're going to get. I think tech earnings this week could probably support the market a bit, and it's a bit oversold short term, all that kind of stuff. So, yeah, I wouldn't be surprised if we got a little bit more off. There's some real challenges on liquidity, and the Fed's, keeps pushing back on cuts, and that's an issue for the market.
So is the word of the week diversification?
Is the word of the week diversification? That's a great word. I think the word of the week is play the bounce. I think that's not that that's one word, but there you go.
I like it.
But yeah, I think diversification is good if you're looking at 6 to 12 months. This market's been very narrow, as we know, in the last couple of years, well, year or so, depending on what time you take in terms of the Magnificent 7. But I think there'll be a much broader stock market going forwards into next year and beyond.
So, Chris, how do you play that balance, given the fact that you're expecting the broader market participation, at least in the longer term? But where should people be putting their money today?
Well, if you're a short-term trader and you want to pay a one-week bounce, fine. Just buy futures and buy call options on the futures, or try playing some of these tech stocks on earnings. But beyond that, really, that's I think you want to think about selling into strength if you're thinking on a 1 or 2 month time frame, because there's more challenges near term. But as I said, beyond that, if one really overcomplicates things, I think we're looking for rotation as you get into the second half of this year and a change of sector leadership globally.
Well, talk to us about what that will look like.
Yeah, I think what we'll see is as rate cuts start coming through from the major central banks of the world, first in Europe and probably the ECB and the Bank of England, and then eventually in the Fed. Over here in the States, that'll start supporting growth cyclically. So, you want to buy cyclicals when central banks are cutting rates. When growth's a bit soft and central bank cut rates, you buy cyclical, old economy, value, also keep buying energy. And you don't tend to buy the big cap tech. They've had a great run. They've been terrific stocks. We've all enjoyed it. But there's too much concentration in those stocks. I mean, I travel around the world talking to people all over the place. Every man and his dog owns the Magnificent 7. It's over-owned. We need to rotate into something else. And there's some incredibly cheap stocks in the US and globally, actually, that will benefit from rate cuts.
Chris, how much of the catalyst, at least in the near term, when you take a look at earnings, those expectations there, when you take a look at, there's still this expectation that the Fed is going to cut before the end of the year, how much of that has already been priced into the market?
Well, in terms of pricing and rate cuts, we've been pricing them out, of course. We've been pricing them out in the last few months. We've been pricing the amount out in next year.
But I guess I just mean in terms of the optimism, right? That run-up that we had seen prior to that recent action that we've seen over the last week or two here. But how much of that optimism do you think is already reflected in these current valuations?
Oh, I think there's plenty of upside in a lot of stocks. I'd be more cautious on the Magnificent 7, but there's plenty of upside in a lot of stocks because we're entering a rate cutting cycle. You know, and the valuation, you can't really judge a market by the level of the PE ratio. You can only really judge it by the flow of money and the flow of rate cuts and that sort of stuff. And actually, if we're going into a mid-cycle slowdown, which I think we probably are, then rate cuts are terrific for the stock market globally. And you want to pick your sectors. But yeah, I think there's lots more to price in that sense.
So you're making me think about like the difference between a tech company and a staple and all of these things. When does Apple become a staple as compared to a tech company?
Yeah, great question. I think it's a defensive cash modest grower. It's sort of in its own bucket, isn't it? It's kind of weird. It's you know, when you know, in the last 12 months you don't want to buy cyclicals because they were hiking rates. So you want to hide somewhere. You don't want to buy, you know, defensives because rates were going up as well, generally. So you hide in big cap defensive stocks, and Apple is a classic example of that. You're comfortable, you can park money there. So I think when we start cutting rates, people will be like, well, I don't want Apple. In fact, to be honest, they've already concluded that, haven't they? It peaked last year in July. So it's a great stock. It was a great run. Buy something else.
Get out of Apple.
Get out of Apple. Use strength as an opportunity to sell it. I'm not a stock picker, by the way, but you can tell I'm a market strategist, and certain stocks behave in certain ways in certain environments.
That's great. Chris, thank you so much. That was really fun. I appreciate you joining us. Thank you. That was Chris Wildlane, Longview Economics CEO and Chief Market Strategist. Well, from top retailer now to bankrupt. Express is the latest clothing retailer to file for bankruptcy. Yahoo Finance senior reporter Brooke De Palma has more on this story. Brooke, what can you tell us?
Good morning, Jonna. Good morning, Maddie. I mean, certainly one expert calling this an inevitable destination for Express. That was from Neil Sanders of Global Data. He said that this retailer really has struggled to gain traction with consumers in recent years, especially post-COVID. It's faced declining sales as it couldn't keep up with that casualization trend. And so here's exactly what we know about Express, that clothing retailer that did file for bankruptcy. They received a potential sale offer from WHP Global here, and they already do own a stake in the company since 2023. They own about a 7% stake in Express. And so ultimately here, what else happened today was Mark Still, he was named CFO permanently. Now he has served as interim CFO since November of last year after their then CFO decided to depart. As part of this whole entire process, the company did announce that it will also be closing 95 Express retail stores, and it will also be closing all of its Up West stores. Now it's important to note here, guys, that despite these physical store locations, the company will still be operating its Express.com, it's Bonobos.com and UpWest.com, all those online sites still, along with all apps. They are still accepting all orders. They're still accepting all coupons. And so really they're trying to make this status quo for all consumers here. But certainly a big announcement. Once again, Neil Sanders of Global Data saying this was inevitable for the company.
So then, Brooke, what's next? I mean, when you take into account the likelihood, I guess, that Express could potentially survive this and come out the other side, what do those odds look like?
Yeah, well, when you think about it, WHP also owns Toys R Us. They also own Anne Klein. So we've seen these sort of companies get bought out, get acquired, and then come out as a different sort of format, a different way. We know Toys R Us is now in Macy's. And one thing it really said to me is that this really allows the company to reset the business. Should they accept that offer, then they can shut down a number of those badly performing stores and still come out in a different way, in a new format. And we've seen this before, as you can see right here. We've seen JCPenney's, Forever 21, Toys R Us all file for bankruptcy. But it doesn't always end up this way. It's important to note here, Lord & Taylor, Sears, of course, they ended very differently. But really Express CEO expressing that he aims to really use this as an opportunity to reset the business and is really assessing all that's on the table right now.
It is great to look at retail because it's such a reminder of the fundamentals of these businesses. And Express, the clothes have not been good since I was in college, you know, which is too long ago at this point in time. Like, it was good for the peak wearing a blazer out to a party season
Good job
of fashion.
interview.
Right, but that is no longer the case.
But I also think, right, the big difference the huge difference, I would say, between Express and some of those names that you just outlined, specifically Toys R Us, is the brand that Toys R Us has, right? That was such a household name. That was something that everyone associated with a great time in their childhood. You had that strong brand where I don't think you can make that same argument about Express. So that kind of changes the dynamic, and I think maybe the odds of exactly how this is all going to play out, but I don't know, we'll see.
No, that's a really good point, Shauna. Brooke, thank you so much for joining us as always. Really appreciate it. Well, coming up here, we have tech on deck. We're going to give you a breakdown of the tech sector's performance so far this year. Plus, a strategist reveals which sector has more room to run than tech. That's coming up after the break. Well, tech earnings are on deck this week with 4 of the Magnificent 7 names reporting. We're going to start it out here with Tesla. I'm going to flip over to the interactive to give you a look at what some of these names have done year to date. If you look at Tesla, down a whopping 43% here year to date, obviously struggling off of a variety of factors, executive issues, layoffs news overnight, price cuts. So a very high bar for Tesla coming into that earnings print here. Also taking a look at Microsoft, down in the morning trade, only up about nearly 6% year to date here. Not a ton of fundamentals driving that name forward here. Also Meta, remember they had a record-breaking earnings print last cycle, adding $200 billion to their market cap, up 34% year to date. So that is going to be difficult for them to beat. And then ending it here on Google, up 10% year to date. I'm going to be curious about whether or not they can add some more details about Gemini in order to increase the likelihood of fueling a further AI rally when it comes to this name, Shauna.
All right, Maddie, thanks. We'll start starting the week with gains, looking to recover from last week's big sell-off. Now, tech has fallen about 7% in the past month alone, and you can see the losses, though, really steepen over the last week. You have the S&P 500 and the Nasdaq Composite both closing lower for 6 days in a row. So maybe today's upward momentum is going to snap that losing streak. But the Nasdaq shedding 2% on Friday alone, its biggest single-day decline that we've seen in 6 months. So is this selling over? Is there more downside risk ahead? Here with more, we want to bring in Jay Pulaski. He's a TPW's advisory founder and chief investment officer. Jay, it's great to have you here. So talk to us just about the selling that we have seen in the Mag 7. Is there still reason, do you think, to own or buy into some of these larger cap tech names?
Yeah, I think, first of all, it's great to be with you. And look, these have been momentum stocks, right? It's been a momentum-driven market, and people were behind the curve. And so they had to race to catch up, which means they go into the momentum names. And they did a typical, market did a typical Wile E. Coyote move and ran right over the cliff and right off the cliff. And so we had, I believe, 20 billion or so in CTA selling last week, just last week alone. And so we've gone from 3 weeks ago, we were talking about a bubble, right? And overbought and extended markets, particularly tech. And now all that's been washed out. So things move very fast. I think it's healthy. It's a feature of markets, not a bug, to have a pullback after a 27% move from October to March. So I actually think I looked this morning, Nvidia, and I know that's not one of the ones you talked about earlier there, but Nvidia is off 20% in the last month. And this is the poster child for AI. And to me, that's an opportunity because we're believers that we are in the early innings of the AI age, and semiconductors are the pick and shovel of the AI age. And so we have been exposed, we are exposed, and we continue to be exposed to the semi stocks in particular.
Nvidia really needs to focus on moving up their earnings date. I think we in the news media, finance would appreciate that. But Jay, I'm curious, as we wait for those Nvidia earnings, what is going to be the thing that drives the tech rally moving forward throughout this month here, particularly given that we're starting things off with Tesla, and I could imagine that their earnings are not going to be very good?
Well, earnings are going to be the factor for sure. That's something we've talked about for some time with our clients. We've kind of traded off rate cuts, which are the thing that excited people in the fall and over the course of the winter, for earnings growth. And these companies, many of them are generating tremendous earnings. But we actually have a different take. We're more keen on tech outside the United States, and in particular in China. And so we have identified what we call a two tech stack divide between the US and China, where both countries are basically sealing off their tech sectors from each other. And we think that creates a real opportunity within China tech, which has been a huge laggard versus the US. Its e-commerce market is twice the size of the US, growing at 10% per annum, where in the stocks like Alibaba, Tencent, et cetera, are trading at a 50 to 60% discount to the United States tech stocks. So we look at Apple, which you were talking about earlier with the prior guest. Apple is the example of a US company and a US stock suffering because it is losing market share in China, which is its biggest market. And it's losing that market share because China is trying to drive its own homegrown tech companies and excluding the US, just like we're doing to them. And so we see tech in China as a real interesting way to play emerging markets, which have been a big laggard.
And Jay, we're seeing this call get more and more attention here. You mentioned Alibaba and you mentioned Tencent. When we're trying to identify that upside, that investment opportunity, what does the upside look like, do you think, in some of these names?
Oh, I think it's huge. I think it's one of the best risk-reward opportunities in the world because these stocks are selling at 8 times. Alibaba's at 7 to 8 times earnings. They're growing. They're going to dominate China and we think probably Southeast Asia, which is the fastest growing region of the world. And so the opportunity, we think, on the risk side, there's limited risk because everyone who wants to be out of China has sold. They're trading at 8 times earnings. They're buying back stock. And the upside, the reward, we think is considerable. As an example, we focus mainly on ETFs here at TPW Advisory. KWEB, which is the China Tech ETF, could double from its current price around $26 and then double again before getting to its March 2021 high, which was over $100. So you look at US Magnificent 7, close to all-time highs until the last week or two. And then you look at KWEB, which can double and double again before it gets to its 2021 high. And so we think that's really quite compelling.
Right, and I know you mentioned that China in general has a lot of room to run with 21% global growth over the next 5 years coming from that region, Jay. So really appreciate you joining us and breaking all of that down. That was Jay Pawlowski, CIO at TPW Advisory. Now coming up, high interest rates might be stunning tech innovation. We're going to speak to Techstars CEO on how venture capital is being impacted. That's coming up after this break.
Interest rates seem to be higher for longer, and global venture capital investments have fallen to a 5-year low in the first 3 months of this year. Now, this is according to the latest data that we're getting out from PitchBook. Well, our next guest warns that higher rates are stifling tech innovation. Joining us now is Mael Gavi, CEO of Techstars. It's a pre-seed investor company here with a direct line of insight into seeing how early stage tech companies are raising cash. Mael, it's great to chat with you here. So talk to me just about what you are seeing, the interest that you are seeing from some of these smaller tech names, and exactly the challenge that higher rates pose here at this point in the economic cycle.
Absolutely. Happy Monday. Thanks for having me. So when we think about the high interest rate, I think the first direct impact it has on tech innovation is that it limits the ability for venture capital firms to raise funds and then invest those funds into innovative startups. And that in turn reduces the availability of capital startups have to build and grow their businesses. And so that becomes a lot harder in general for tech innovation to appear. That would be the prime driver.
So where are we at in this cycle, Mel? I'm curious, obviously, when we're in a zero interest rate environment, that is amazing because we got a bunch of cash sloshing around. Then that went, and we saw a big slowdown, and we're making our way out of that. Is the slowdown totally in the rear view from your point of view?
So if you're asking me my forecast for the interest rates, my crystal ball doesn't always work perfectly. I would say, look, the Fed is likely going to try to cut the interest rate because of the election pressure. It happens every time. But because the inflation numbers are so high, 3.5% last month and going up from the months before, it is too early for them to do so. And when we're having conversation with LPs, we keep hearing that, which is, interest rates are high. For the LPs who have multi-asset class strategy, they compare the VC asset class with others, and then they start saying that, you know, they may find fixed income or other asset class more attractive in this high interest rate environment. And so as of today, I am not seeing a fundamental change, even though everybody is hoping that there is going to be an interest rate cut with the election coming.
Mael, you put in your notes here that 2024 is going to be the year here of the great venture reset. So talk to me just about that. And then when you talk about the fact that we have this higher for longer rate environment right now, what is that going to do just in terms of competition within the VC space and ultimately, you would think, increased consolidation potentially at one point?
So I think when it comes to the VC environment, we're already seeing, mostly in the back rooms, but very much there, the consolidation at play. You see more and more VCs having a really hard time to raise and moving into what we call the zombie mode, which is when a VC is still active because they're still managing their previous funds, but they can't raise a new fund. And so they're basically step by step closing shop, but they don't have to say so publicly. Again, the fundraising has been pretty difficult. In 2023, the US venture capital firms raised about $67 billion. That was the lowest annual total since 2017. And that was a 60% drop versus 2022. So it's a pretty substantial changes. And I do expect some further consolidation there.
All right, Mael, we're going to have to leave it there, but thank you so much for joining us, and hopefully you'll come back soon. Really appreciate it. That was Mael Gavi, Techstars CEO. Well, today is a very big day here at Yahoo Finance because the opening bid makes its debut. Today, Yahoo Finance's very own executive editor, Brian Sozzi, spoke to Jay Woods from Freedom Capital Markets. He's their chief global strategist. Here's what he had to say about Nvidia after its worst day since 2020.
Great opportunity for those that have been waiting for that dip in a stock that continues to crush it on the earnings cycle in the hottest space, is the best name. It's a good time to dip your toe in the water if you think and believe, like I do in Nvidia, over the long term, that this pocket is absolutely a great opportunity to add to the stock or get in for the first time.
And from the star to the problem child, Tesla. Here's what Troy Gajewski, FS Investments chief market strategist, said about Tesla's outlook in the EV market.
Tesla's a great brand and revolutionary in terms of market positioning, but it's a challenge business, right? Let's just face it, saturation of the electric vehicle market, right? And so I think those that have been bullish on Tesla for years have always said that is how they get started. And then you're going to have the battery storage side. And even though you've had growth, we don't know if that growth's strong enough to offset the stagnation in EVs. And then
all right, well, sitting with us now, we have the one and only Brian Sozzi. Brian, congratulations on the launch. This is a big deal.
Yeah, big deal for our team in general. Like, hats off to our very own Ken Underwood, Alex Frangiskidis. I always say his name wrong, but I think yeah. But anyway, these guys are amazing. They're up around the clock to make this thing happen. It's for me, it's really cool to see us up before 9 a.m. each day with some really interesting market insight and really deep conversations. You saw Troy and Jay there, but over the course of the next several months, we'll have a lot of surprise guests. Start tapping our Rolodex of CEOs for really longer term, some really in-depth chats. Not to, the competitor in me, surveys the landscape in business media, and I can't help but to think there's still a lot of folks talking over the heads of investors. And I listen to a lot of our competitors, and I think I need a rocket science degree to figure out what in the world they're saying and like 8 doctorates. I respect their work, but I think there's a real opportunity to actually speak clearly and coherently to the average investor, which is the Yahoo Finance community and someone we look to serve every morning in a friendly, welcoming way. So that's what we're going to do with Opening Bid. We'll have a little fun and hopefully make some news.
I can't wait to
Congratulations, because we are looking forward to it, and this is going to be every Monday and Friday, right?
It's so weird, like I'm doing this no tie. Actually, during the episode, I went to fix my tie, and I realized I had no tie, so I had to call myself out to Troy and Jay.
It's a new look for size.
Well, every day it's going to change. Some day it'll be hoodies, some days t-shirts, some days polos.
New media.
Yeah.
Vests, if you're talking tech earnings.
Yeah, maybe some tank tops, too. I have no idea. It's summertime.
Wow, it's going to get real interesting.
I'm working out hard.
On the opening bid.
Well, let me tell people where they can watch this thing, Sozzi. Every Monday and Friday, 8 a.m. Eastern Eastern across all platforms, right? We're talking Spotify, we're talking YahooFinance.com.
I'm going to wear the tank tops. I'm actually going to wear the Spotify, Apple Music, Yahoo Finance platform, and
I don't know if that's going to excite viewers or scare them.
It's going to excite viewers. Trust me, I've been working out hard.
Okay, there we go.
We have to go to the break. You are watching Yahoo Finance. Well, more speed ahead for Ferrari. Analysts at Evercore ISI see nearly 15% upside for the stock. The firm raising its price target to $465 a share from $430. They cite combined accelerating growth and less exposure to the trouble spots in the global luxury markets, including, of course, China. And that part is, to me, Shauna, what's so interesting, because this is a refrain we've already heard echoed throughout earnings season that just kicked off. LVMH talked about struggles from China. Obviously, this is impacting Tesla as well. So it continues to be a headwind.
Yeah, exactly. At least when it comes to Ferrari here, China is only about 10% of sales versus 33% of most luxury brands. So we can put that into context. It does show that they are a bit more shielded here, at least compared to the rivals of the slowing down or the slowness that we are seeing play out, continuously play out within China right now. That prolonged recovery is still not really taking hold, at least to what forecasters had anticipated it would look like up until this point. But when it comes to Ferrari, Evercore coming out with a number of reasons to remain optimistic on this name. Now, and I guess just to point to that fact, some of these reasons that they are optimistic, they're seeing growth accelerating into 2025. They're seeing some excitement surrounding the F1 coming up in Miami, some of the EV plans there, what exactly that is ultimately going to do for Ferrari's bottom line going into the future here. And then also just the combination of a good offense, they're saying, and less exposure to some of those trouble spots that we were just talking about, that really positions Ferrari well, at least amidst some of their competition at this point. Yep. All right, let's do a final check of the markets. We've got about, well, I guess we're 90 minutes into the trading day. So let's take a look at some of the gains that we're seeing across the board. We're well off the highs of the session, but the Dow still holding on to gains. You got the Nasdaq trading just above the flat line.
And coming up, our new show, Wealth, dedicated to all of your personal finance needs. Our very own Brad Smith has you here for the next hour, so stay tuned.
Hey everyone, welcome to Wealth. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. On today's show, tech's big sell-off ahead of earnings. We'll explore how to play it. And Tesla is cutting prices. If you're in the market for an electric vehicle, what should be your top consideration other than price? We've got that conversation. Plus, housing hurdles. A percentage of young families are having to rent instead of buy. We dig into when that may shift. But first, let's take a look at some of the market action here. We're 90 minutes into the trading day, and here are 3 things that you need to know about where money is flowing in the markets right now. We're tracking gains for the 3 U.S. major averages here for the Dow, the S&P 500, and the Nasdaq. Stocks are attempting to recover after a big tech sell-off last week. The tech sector is off by about 8% over the last month, those 30-day periods. And you can see last week's big declines. The Nasdaq falling 2% Friday alone, dragged by Nvidia, where shares saw a steep 10% decline. This all comes ahead of a big week, huge week for quarterly report cards. A handful of the Magnificent Seven members, Tesla, Meta, Apple, and Microsoft, they're all reporting results in the coming days. Now, tech has been one of the hottest trades of the past year, pinned to AI hype, artificial intelligence. And Wall Street is tracking a bad setup for one name particularly, who has become more AI annexed, and that's Tesla. Layoffs, a recall for its Cybertrucks, and price cuts in the U.S. and China. The EV maker slashing prices for 3 of its 5 models in the U.S. by $2,000. Tesla is facing falling sales and increased competition in the EV space. And the 4th ever Bitcoin halving event, that another big item that we got to get on your radar, that went into effect. And it means the reward to miners has been cut in half. This is done to reduce the rate new coins are created, lowering the supply, which maintains scarcity. Now, historically, there's been an increase in the price after this event. Bitcoin currently right now hovering just above $66,000, which is roughly 10% off of some of those March highs. Well, our thanks as well here as we continue to move through and really dive in to tech earnings on deck this week to Dow Jones market data. Why do we think Dow Jones market data here today? Well, the Magnificent Seven shed $950 billion in market cap last week. They were able to track that stat. And there's the big question of, can earnings bring optimism back into the sector for how to position your portfolio to brace for whatever may come next? Let's bring in Anthony Sakaro, who is the Providence Financial and Insurance Services President, here with us. Anthony, great to see you here. First and foremost, the setup going into earnings for the Mag 7. Do you expect a major shift in sentiment to occur as a result of what these companies have to say?
Thank you for having me, Brad. I'm kind of surprised that a major sentiment hasn't already occurred. The fact is that the stock market is right now, or has been running on what the Federal Reserve is going to do. That's been the impetus behind what the stock market is. Now, all of a sudden, the stock market's actually going to have to change and focus on what it should be focusing on, and that is earnings. Earnings season started off strong. It looks like it's going to continue to be strong. I think the stock market's going to sustain itself. I actually think earnings can actually bring the market back up to its highs. We're 5.5% or so off of our highs. I think the earnings season is going to bring us back up there. But we're not out of the woods yet either. The Federal Reserve still comes into play. And if at the beginning of the year, it was predicted and forecast that the Federal Reserve would lower rates 6 and 7 times this year. Then it dropped to 3 times. And I wouldn't be surprised if the Federal Reserve doesn't lower interest rates at all. They're going to have a reason to lower interest rates. They can't just lower them just to lower them. So now all of a sudden you've got a good economy with no reason to lower interest rates. And that's going to be on one side. And then you've got earnings on the other side. So there's going to be this interesting balancing act between earnings and interest rates and how investors react to that. But overall, I don't think it's a bad scenario going ahead.
How should investors react to that? Should investors be concerned about that?
So it really depends on what phase of life you're in. If you're in the retirement phase of life, you have to remember the market can have a major crash at any point in time. And we could be starting a major downward slide. I'm not saying we are. It's just that could happen. In 2007, if you wanted to retire a couple years later, you wouldn't have been able to because the market was down by 60%. So if you're in that retirement phase of life, you really have to be careful. What I would do is focus on more conservative investments, probably starting about 10 years out, shore your portfolio up, focus on more conservative investments, and focus on investments that are going to give you income, interest, and dividends. Those investments tend to be more conservative and they tend to be less volatile. If you're younger and you have years to go, then you really want to keep doing what you're doing. Keep dollar cost averaging. It doesn't matter what the market does in the short run. You have time on your sides. And the ironic thing about dollar cost averaging and having a couple decades ahead of you while working, the ironic thing is that if the market goes down, it helps you actually because you get to buy more shares for the same dollar. So have a plan, stick to the plan, but focus on your phase of life and where you need to be.
What is the playbook for choppy markets? Of course, that differs for everyone based upon, as you were mentioning, phase of life. But at the same time, there's kind of a basic playbook that investors should be able to enact. What does that look like?
Yeah, again, I think it depends on the phase of life that you're in. If we're focusing on the younger generation, the phase of life or the playbook is going to be dollar cost averaging. Dollar cost averaging is when you're buying the same dollar amount of whatever investment is over and over of time. The math shows that it drives the average purchase price down. That's what happens, and that's what you want to do is you want to buy low. So if the market drops and you're buying shares periodically, that's good for you. That doesn't hurt. We don't like to see our portfolios go down from an emotional standpoint, but from a mathematical standpoint, that drop helps you. So don't fret. The biggest mistake I see investors make back in 2001 and 2008 when they were younger is they got scared. They saw their portfolio drop and they sold, and a lot of people have been there for 15 years since 2008. Don't do that. Keep dollar cost averaging. Younger, that's the basic playbook. Older, interest and dividends, because you can spend your interest and dividends. Your portfolio is going to fluctuate, but if you're living on your interest and dividends, then the fluctuation doesn't mean anything. It's like collecting rent on a house. As long as that rent payment's on time, the fact is it doesn't matter what the value of the house is at any point in time. And when you're invested for interest and dividends, you're collecting rent on your portfolio, and it makes it a much more stable, and you can count on your income. And for the older generation, that's really the best way to go. That's the basic playbook.
Anthony, some great reminders there. Thanks so much. Appreciate it. Anthony Siccaro, Providence Financial and Insurance Services president, joining us here today to kick off the show. Turning now to the #1 trending ticker on Yahoo Finance's website, Tesla. The EV maker is cutting prices in the U.S. on 3 of its EV models, the Model Y, the S, and the X, all now cheaper by about $2,000 a piece. Here with more on the news and whether or not it's a good time for consumers to get into the EV landscape and the market is Yahoo Finance's Pras Subramanian. Pras, you've broken down in the past for us the considerations that people should kind of check off in their mind as they're thinking about purchasing an EV. How do some of these price changes also perhaps have a material effect on that?
Yeah, you've been talking about this for a while now and seeing the price sort of changes. Tesla kind of rolling back price hikes that it put in place after Q1 ended. So we're seeing them come back, at least in the low end with that Model Y, that entry-level Model Y coming back to the cheapest level it's ever been for a new car. And I wrote a story a couple months ago about how now is the time to buy EVs. And we're seeing that with Tesla price cuts here. I've spoken to some sources at Hyundai and Kia and at dealer sources, and they told me that there are hundreds of EVs sitting on outside lots that they need to sell. And they not only have Hyundai corporate incentives, but also dealer-specific incentives they need to move these cars. So the question is, how long can this last? And I have to imagine that most automakers can't keep selling these cars at a loss, right? So I don't think this is going to last that long in terms of getting a really cheap EV. Companies like GM have talked about how their Ultium platform is going to allow them to sell cheaper EVs that they can actually make money on. Probably in the next year or so, they're going to report profitability on a variable basis, right? Like, so any new car they make will be profitable, not so much when you back in all those fixed costs. So they're getting there, right? They're getting there. The question is, when will it take where they can actually sell cheap EVs and actually make money? And I'm not sure yet when that's going to be, but right now, if you want to buy an EV, whether it's going to be a Tesla or it's going to be a Hyundai or even great deals on luxury EVs, you can do that right now, like an EQS.
It's interesting, the price cut. I mean, and correct me if I'm wrong, but that $2,000 price cut for some of these Teslas is also the cost of the full self-driving package as well in some of these cases too, or at least the ballpark.
Well, so they cut the prices of that, right? So if you want a subscription, it's $99 a month as opposed to, I think it was $200, and then they cut the $12,000 upfront cost to $8, I believe. They really did cut those prices down for that big bet in FSD. Lot of sort of talk as to can they monetize that? Are they ready for this? Is the robotaxi going to come out? Who knows?
Okay. Yeah, we were promised a robo-taxi service, a fleet by 2020. A lot of other things happened in 2020, but we did not get a robo-taxi fleet for those keeping score at home. Prosper remaining. Thanks so much. Appreciate it. Well, Bitcoin completed its halving on Friday, the process that happens every 4 years. The event helps control the supply and shape of Bitcoin by reducing the mining rewards over time. Now, prices higher on the news, and Bitcoin bulls are pleased to see the upside this morning as it's up over the past 24-hour period by about 1.4%. But for those who aren't invested in Bitcoin and looking to get into the crypto market, perhaps, it could be a good time to think about it. For more on this, I'm joined by Tyrone Ross, 401 financial principal and founder, to weigh in. He's got his Bitcoin t-shirt. I mean, that's like a la champion logo that we had seen. So in the stylings of that, great to see you, Tyrone. Walk us into the thought process that a lot of people should be thinking about with regard to this most recent halving and whether or not it's time to consider adding Bitcoin to the portfolio.
Yeah, key word there is thinking. I think if you were thinking about getting in, you should continue to think about it. The halving shouldn't change anything there. It's literally written in the code, tick-tock, next block, as we say. It's just going to continue. It's not this special thing or magical event that makes Bitcoin any more or less compelling to invest in. Because if you loved it 2-3 years ago, you should think about loving it now and continuing to learn. With that said, folks that are thinking about getting in, the halving is something that you should learn about and realizing, as you mentioned into the lead here, the decrease in supply and demand. We all know about that. We've heard about that. But some of the other dynamics that are out there with the Bitcoin ETFs, the price of running up into an all-time high before this halving, which is the first time that it's happened. So things like that, I think, are interesting to learn. And then if it still makes sense from you from a long-term time horizon, it would make sense to buy then, but not a second before.
I mean, with the amount of supply, it seems like there are going to be halvings. I believe the year that I saw was into 2140. It's going to far outlive any of us unless we come across Tony Stark's arc reactor between now and then, and we're able to exponentially add on to our lifespans. But all those things considered, when you think about the limited supply that is baked in, how much also in advance of having events like this do we see it get baked into the price? And a lot of investors already expecting the event to come about, so them trying to get ahead of what that price action would have been or could have been.
Yeah, and on crypto X last week, there was a lot of argument, as it was in the previous halvings, about is it priced in? Well, yeah, for all intent and purposes, for something that is written in the code and you know what's coming, it's priced in. But if I know every Friday that my parents are going to take me to McDonald's as a kid, it's priced in. I know that excitement is coming. But certain things may change. It may be raining that day. They may be late to pick me up. The French fries might be cold. I still went to McDonald's. So what am I saying here? Yes, it's priced in, but everyone interprets that information differently. So I think what needs to happen is, yeah, it's priced in. The more you understand and you are close to the Schelling points with Bitcoin and everything that goes on in crypto, it's easier to get information to make decisions. But I can tell you, I am almost 11 years into the space now. The halving was nothing for me. It was, I said this on social media, I think we're going to look back years from now and ask people, well, how many halvings have you held through? I think that's going to be the metric, as opposed to did you buy before it or did you buy after it? I don't think that's the thing folks should be looking about if they're looking at this as a long-term addition to their portfolio.
We want to introduce folks to a new term as a result of this halving as well. And we spoke with Fireblock's CEO, Michael Shalov, who gave us the definition, at least from his perspective, of runes here. And then I want to get your reaction on the other side of this. We're just going to run a clip real quick.
We'll start seeing more and more players that are able to offer access to a bigger investor base. So essentially both retail and professional and institutional investors. And that will probably what would start driving the prices up, both for Bitcoin and other cryptos.
Okay, so that was his reaction to what the institutional side is looking for with this new protocol. I would love to know from your perspective what the significance of this runes protocol is post-halving.
The significance is what you saw for the 100 blocks post-halving. It was very interesting to see it on social media, was just the amount of fees that were being paid to the blockchain, it was remarkable to see how much fees increased. And one of the issues that folks have always talked about was when the supply goes away and there's no more Bitcoin to be mined, then what happens for miners? And I think those fees show that there are people that are going to use Bitcoin and willing to pay fees in order to introduce themselves to the security of the base layer and make things immutable. And runes are just essentially meme coins for Bitcoin. And all that means is that you'll be able to, and you saw all these funny names for coins that now are going to be introduced on Bitcoin like it is on other chains like Solana and Ethereum and things like that. So it introduces a really interesting dynamic of you can use the Bitcoin blockchain for whatever you want. And you got some Bitcoin maxis who hated it because it clogged blocks. And, you know, the miners love it because the fees are there, but that's the beauty of Bitcoin. It's different things to different people, and no one gets to choose what it is or it isn't.
Tyrone Ross, 401 Financial Principal and Founder. Tyrone, great to see you as always.
Of course, my man. See you soon.
See ya. Well, coming up, everyone, Verizon is out with first quarter earnings. If you're a customer, we'll bring you the 3 things you need to know from the report. Plus, how to pick the best phone for you. We're going to dig into the details on the other side of the short break. We are nearly 2 hours into the trading day. Let's do a check of the market sponsored by Tasty Trade. You're taking a look at the U.S. major averages as of right now. We're still holding on to gains across the board. The Dow flat just barely to the upside. The S&P 500 is up by about 0.1%, and the Nasdaq Composite holding on to it by a hair of its chinny chin chin right now in the green by 1/100th of a percent. Turning now to a trending ticker on Yahoo Finance's site, shares of Verizon, ticker symbol VZ, reversing course this morning. Initially, it was moving higher, now trading lower after reporting mixed results in the first quarter. Adjusted earnings per share coming in at $1.15 versus the $1.12 estimated. And then the telecom giant did see a slight revenue miss for the quarter as well, but moving away from the high-level headline. We want to dig into why this report matters. If you're a customer of Verizon, here with more, we've got Yahoo Finance's Madison Mills. Hey, Maddie.
Hey, Brad, thanks so much. So it is interesting to see the market reaction here because it points to the bifurcated consumer that we're seeing in the economy, and that is playing out in this Verizon earnings print. Just to run through quickly, we are seeing the stock down about 4%, but the reason we want to look at this from a consumer perspective is what is happening to the higher income earners that are typically a Verizon customer. Remember that Verizon is typically a little bit pricier compared with competitors in the space like a T-Mobile and AT&T. So this could be an indication of how that group of people is faring against this economy. I want to take a look at the three things that I want to pull out for Verizon here. In terms of the report card, did get better than feared numbers when it comes to the earnings print. We're seeing that their consumer business is better than it's been since 2018. Again, seeing that resilient consumer, but you look under the hood, and then I want to go through the other points here because with wireless, you did have fewer subscriber losses, but in the third point that we have on the board here, we're seeing that Verizon internet signups are continuing to slow, and even though I mentioned their consumer business is still strong, we're seeing that consumers are holding on to their phones longer than ever recorded. So that could be an indication that this consumer is trying to save money, prepping for an economic downturn that could still be to come. So I wanted to bring you some of my tips for getting a more affordable internet bill. The source here is myself, Madison Mills. So here's what you can do if you want to give a call to Verizon and get that bill lowered. You can call and ask for a loyalty discount, particularly if you've been a customer for a while. They do offer discounts ranging from $10 to $25. Just call and say, hey, I heard about this. Can I have it? They'll likely give it to you. Mention that you're looking at other providers on the call. That is my personal favorite tip. Whenever I call asking for a discount, just throw it out there that you're considering your options in this space. You know, keep it light, keep it testy for them. And then also make sure you're using all of Verizon's perks. Just as of last week, they added additional streaming giants to their flexible and bundles rather. You can get Disney Plus, Discovery, Netflix discounts, Max discounts, depending on which plan you have. So make sure that you're utilizing all of those perks so that your monthly bill for Verizon you're getting the most bang for your buck when it comes to that monthly bill, and you're not double paying for any streaming giants that you don't necessarily have to add to your monthly expenditures there, Brad.
All right, I just took a screenshot, Maddie, of our Yahoo Finance feed, just so I have those tips as well. I probably could have just asked the producer for it. But anyway, one way or another, great tips, Maddie. Appreciate it. And the takeaways from the earnings period here. Yahoo Finance's own Madison Mills. Well, when is it time for you to get a new phone? That's the big question. You might be waiting for the newest announcement from Apple or Google Pixel, whatever. You may be just waiting for your battery to get so low that you become that person who's always looking for a place to charge. It's me. Hi, I'm the problem. It's me. No matter when you decide the time is, it's always good to get the latest tips on how to get the best deal for what you're looking for. Joining me now is Lisa Edichico, who is the CNET senior editor, joining us here on set. Lisa, great to see you. Thanks so much for joining us. We were just talking about this, how long I've been holding on to my phone, how long you were as well, but you finally upgraded. So what are some key factors that people should consider when selecting what phone to buy?
Yeah, absolutely. I think two of the biggest things to consider, aside from your budget, of course, is the screen size of the phone itself and the cameras, because those are the two things that people use the most in their day-to-day life. Of course, the screen that we're staring at all day, you want to make sure it's big enough to watch video, read your email, things like that, but you don't want it to be so big that it feels overwhelming to hold and use with one hand. And then the camera, of course, we use to document our memories, take photos of pets, things like that. So you really want to make sure those two things are checking your daily needs, because those are also two factors that you can't really change once you buy the phone, right? Like you can always buy more cloud storage if you need it. You can buy accessories to, charge your phone on the go if you need it. So I would say those are two of the biggest considerations for sure.
Now, it also comes with a selection process of which carrier. How do people know where to evaluate or begin evaluating the carriers as well out there?
Yeah, absolutely. So a lot of that will kind of vary depending on your location, right? So I think a lot of people do tend to stick with the same carrier if they're happy with their service, but there might be various reasons why you might want to switch. You might find a better deal elsewhere. A lot of carriers will also try to entice you to switch with certain deals. So I would say if you're trying to decide on a carrier, think about your budget. I know one of our top picks, if you're only subscribing for yourself and you don't have multiple lines that you need to have, is T-Mobile has a great unlimited plan. But really think about your data needs, your location. And the nice thing about that as well is that you can actually try out the network before you decide whether you want to commit. A lot of carriers let you do this. You can essentially just try out the network commitment-free for a certain period of time to get a feel for how the service is in your area. So if you are thinking about switching carriers, I would definitely recommend trying that.
That's a key note right there. So the timing, a lot of people try to strike the right timing. We're waiting for all the big deal announcements, but also the one more thing at the end of some of these keynotes that take place, whether it be from Google or Alphabet or whether it be from Apple. So how do we know the timing and making sure that we're getting into that new phone at the right time to make sure that we're getting the latest and greatest technology as well?
Yeah, the good news is a lot of these companies tend to release phones around the same time every year, so they kind of have an annual schedule to it. So if you're an Apple fan, you probably don't want to buy a new iPhone in August because the new one is going to come out in September, right? So that's always really good to keep in mind. For Google, it's usually around October is when they release new Pixel phones. For Samsung, it's usually around February, sometimes January when they announce new Galaxy devices. So I would definitely recommend doing your research because even if you don't need the latest and greatest phone, a lot of the older models tend to go on sale and are discounted when the new one comes out. So either way, whether you want the latest and greatest or if you just want to save some money, it's worth waiting.
Some solid reminders and tips there. Lisa, thanks so much for joining us in studio.
Of course, thanks for having me.
Lisa Edichico, who is the senior editor at CNET. Thank you. Well, also everyone, coming up, why you may need a sinking fund for your next big expense. Plus, how to have necessary money conversations around retirement, all of that on the other side of this short break. Do you have a special trip coming up? Maybe a birthday or a wedding to attend? Well, if you do, you may want to start a sinking fund in order to save up the money for it. Here to break down exactly what a sinking fund is our very own Yahoo Finance contributor, Ross Mack. Ross, great to see you. So let's start there. What is a sinking fund and when may someone need one?
Brad, thanks so much for having me. Listen, I think when it comes to a sinking fund, you got to say to yourself, okay, what do I have planned out? Because I think all things in life, you can afford it, so as long as you make a plan for it. And now a sinking fund is saying, okay, I want to work backwards. Say at the end of the year, I want to go on a big vacation. Well, guess what? You want to work backwards. Say that costs, I don't know, $5,000 and you have, call it 10 months to get there. Well, the reality is you want to be putting $500 aside every month so that once you get to this big destination, you're not out here being oversaddled with credit card debts or the idea of actually taking out a loan, or more importantly, you don't want to deplete your overall emergency fund, right? I think, once again, as long as you're setting up a plan, you're going to ensure that once that event comes, that big goal, you're not going into debt just to actually try to keep up with your friends.
How do you separate then sinking funds from your usual savings that you would put away?
I love it. I actually love the idea of having a separate account, and where I would love for you to have it as a high yield savings account, right? Where you're actually getting paid for your money sitting there. But once again, you open up a high yield account that could be somewhere online. I would definitely Google who's paying, the best high yield savings account. Obviously, you want to ensure that it's FDIC insured. But hey, your money's sitting there and you're getting 5% or so on average. But once again, you're separating those funds. And once again, you establish what your goals are. It could be a house fund. It can be a new car fund. It could be vacations, weddings, etc. But now you're silently putting money aside, maybe every paycheck or every week or every month. And the goal is the moment that goal gets there, you're not going into debt for it.
Exactly. All right, Ross Mack, thanks so much. Setting up the sinking fund thought process for a lot of folks out there. Appreciate it.
Thank you.
Well, retirement, it's an exciting time, so I hear. But what happens when your partner retires before you? To break down how to balance money conversations when one half of the couple is retired, we have Yahoo Finance reporter Carrie Hannon. Hey, Carrie.
Hey, Brad, great to be here. This is a big issue, particularly this year, which is peak 65, which means more people are turning 65 this year than in any other year previously. So a lot of people think about retirement. And a study I saw last week, Ameriprise, came out with a study, said that most couples are fine with the other person retiring, but very few couples retire at the same time. And so that becomes an issue because you're shifting from saving to spending. So your roles are shifting in your relationship. And what happens is resentment can really build up because most couples actually do not agree on spending priorities. So it's really critical for people to pay attention to some of these very basic things before this resentment starts to fester. And so I recommend people really take the time to, have a money date. I mean, prior to stepping away from the workplace, if one partner's stepping away, you need to have that conversation about, okay, where's the money coming from? How, like I said to my husband decided he wanted to step out at age 70, but I said, hey, okay, so how are you going to pay yourself? So you need to think about setting up what we're used to getting a paycheck. So you need to set up which accounts are you going to pull from? These are big questions to ask. And you also need to think about, I think it's a great idea not only to have that money date, but also to bring in a financial advisor. If you're not already working with somebody, it's really important to bring somebody who's sort of unbiased, that can holistically look at all your accounts and say, okay, let's set up a recurring payment that's going to cover these costs going into the accounts so that there isn't this disconnect about one person earning and one spending. And so this can become an issue. And frankly, what's really important is you got to think about marriage. Marriage is at its very heart a business partnership. So it's cash flow, it's income in, it's spending out. So you really need to be in the same page. And I just think a lot of couples are going to be facing this in the next period of time. So it's important to get a grip on it.
All right, important to get a grip on that. 65, peak 65. I did not know that, Carrie. All right, thanks for enlightening us here and giving us a little bit of usable data as well along the way. Appreciate it. Yahoo Finance's own Carrie Hannon. Coming up, everyone, it's a big week in tech earnings for some of the top companies that are expected to report. You're taking a look at some of the logos on your screen right now. We're going to break down what that could mean for you and your portfolio. That's next.
Are you frustrated about the housing market? You're not alone. And don't worry, we'll show you options like this Toll Brothers new home on Long Island, New York. This home hasn't even been listed yet. I bet you're wondering, can I even afford a home like this? Not a problem. Home builders have been offering incentives like price cuts to attract buyers. Join us for Yahoo Finance's Real Estate, the New Reality. A special where we talk with experts, including real estate brokers, as they navigate these new commission fee rules. We'll also tap into commercial real estate. Are cities evolving and addressing the housing shortage? Tune into Yahoo Finance Live all week long.
Big week for big tech as a lot of earnings are on deck here. To learn what you should expect to hear, we've got Yahoo Finance's very own Josh Lipton. Hey, Josh.
Brad, that's right. So big tech is on deck. Let's get right into that. This week, we're going to hear from some big names. You got Alphabet, Meta, and Microsoft. Then remember, next week, Apple and Amazon are going to deliver their quarterly confessionals. Now, heading into this earnings season, the XLK, that is the technology tracking stock ETF, is up about 30% over the past 12 months, but it's basically flat now so far this year, and it's actually down nearly 10% this month. I checked in with CFRA's Sam Stovall to get his take on just all things tech. Stovall tells me he is looking for Q1 earnings growth for the communication services sector of 27.4% year over year. Now, he is overweight that sector, meaning he is a believer. He argues that companies exposed to online advertising, so think about names like Alphabet and Meta, they will benefit, he thinks, from AI, as well as events like the Olympics and the presidential election coming up later this year. For the information technology sector, he sees a 20% jump in earnings growth, and Stovall is overweight that sector as well. EPS growth this year, he says, is projected to outpace the broader market. Another tech bull is Dan Ives over at Wedbush. Now, he bets this earnings season is going to be approved to be a positive catalyst. Tech stocks will go higher, he argues, for the rest of this year as growth and earnings accelerate, he says, versus street expectations. In part, he is making that bet because of the boom of interest in, you guessed it, AI. Now, what is he bullish on? His top picks right now include Microsoft, Alphabet, Amazon, Meta, and Palantir. He's also a fan of cybersecurity names, too, such as Zscaler, CrowdStrike, Palo Alto, and Checkpoint, Brad.
Now, this all sets up next week's earnings as well here. What could we potentially hear even from a name like Apple?
So Apple is really interesting because they've been under pressure for kind of like a few different reasons, right? So I think if you were a bullet point them, Brad, they would be one, kind of concerns about what is this company's AI strategy. I think there's broader concerns about the China business, which we know has been under some pressure. And then third, obviously, you know, the company has been under increasing regulatory scrutiny on both sides of the Atlantic, both here and in the EU. I think on points 1 and 3, AI and regulatory scrutiny, I don't think you're going to probably get too much news. Particularly in AI, I think you're probably going to have to wait for their big software show in June. But how their China business is doing, that will be a focus for investors. Investors will make a beeline for that data point. You know, there's been different kind of challenges Tim Cook's been dealing with over there. One is, we know, kind of just a broader, shaky economy. And two is he's got competition from the home team, you know, names like Huawei. So it'll be very interesting to see how is that business holding up and what does he see kind of near intermediate term there.
They're going to be reporting earnings Thursday, May 2nd. Yeah. And investors might want to hear a little bit more about what they have to say in September, of course, at the big event that happens every year where we get some type of acknowledgement on what the future holds for the iPhone as well here.
You know, Tim Cook does not, you know, he's a bit different than other tech companies. Yeah. He does not traditionally kind of tip his hand as what's coming, right? It is interesting. He has talked about AI, which in and of itself is interesting that he wouldn't talk about that because, again, he does not talk about when his product pipeline. I think if you were talking to bulls, Brad, that is part of their thesis that some type of Gen AI products are on the way, that some type of AI-enabled iPhones are on the way, and that they're betting when Tim Cook takes the stage, to your point, in September, tells Brad what are the new and fancy gadgets.
That's all I want to know.
It's going to be AI-enabled.
That's what will finally get me off of my 12 Pro Max here and into the upgrade cycle.
You and a lot of other people. Tim Cook hopes. Yeah.
Exactly. Thanks so much, Josh. Appreciate it. Big week in tech earnings here. Also a big week as we're talking all things real estate on Yahoo Finance as part of our special Real Estate, the New Reality. Our first topic, the rental sector and how build-to-rent homes are changing the market. Stay tuned. You're watching Yahoo Finance.
The rise of home prices in the United States is a reality you can't ignore. For many of us, our home is the most valuable asset we'll ever own. But homeownership is feeling more and more out of reach for many Americans. With mortgage rates near 7%, the average monthly payment is now over $2,000. Bankrate reports. These elevated rates are, however, being offset by a lack of supply. CoreLogic projects that year over year, home price gains will continue to rise at a slower pace for the rest of 2024. This could mean more of a foothold for potential home buyers. But the barriers are real. A Zillow report from February says new homeowners need to earn more than $106,000 annually to be able to buy a home in the U.S. That's an 80% jump from what Zillow projected a household could comfortably afford in 2020. Now, with the Federal Reserve expected to cut interest rates this year, many are hoping we could soon see some relief in the housing market. We cover all of this and more on Yahoo Finance's Real Estate, the New Reality.
Housing costs remain high across the U.S., and with mortgage rates topping 7%, buying a home seems even more out of reach, with many young millennials and Gen Z resigned to renting for the foreseeable future. But renting doesn't have to mean the usual apartment hunting. Many areas are now offering brand new homes available to rent called the build-to-rent market. Joining us now as part of our week-long special, Real Estate, the New Reality, is David Reynolds, who is the Mill Creek President of Investment Management. Great to have you here with us. First and foremost, just break this down. What is the growth that we're seeing in this rental home market, or the build-to-rent type market?
Yeah, no, the build-to-rent market, it's a relatively new concept. And just to define what it means, it's a purpose-built community of single-family homes available for rent. And these communities typically have amenities and they have dedicated property management. And if you look at the total universe of BTR to date, it's about 340,000 homes. And the expectation, this year starts are expected to be somewhere between 50 and 60,000. And that's down from a peak of 90,000 just a few years back.
So build to rent, but then on the other side of this, is there the opportunity for some of the tenants to be able to rent to own one day as well?
Well, there are concepts, there are groups out there that are looking at doing things like that. That's not what we do. We're fully focused on the build to rent product. And we like the product. We're filling a need in the market, and it's an affordable alternative, and it's appealing across generations.
And so affordable right now because there are many people that are perhaps blocked out from making a purchase, especially with mortgage rates the level that they are right now. And so without a cutting process initiated by the Fed on rates, how long is build to rent going to have some legs in this near-term period of time from your estimation?
Build to rent is definitely going to have legs for the long term. If you look at the institutional ownership of single family rental, it's only 5%. And single family rental represents about 11% of the total housing stock in the US. It's about 15 million single family rental homes. And at 5%, that means institutional owners only currently have about 750,000 homes.
How does the build to rent pricing compare to typical apartment pricing or typical other rental unit pricings?
It's going to be comparable to apartment living. If you were talking about a like location, by its nature, a lot of build to rents are a little further out. So you'd have to be comparing to like apartments, but you're getting so much more with the build to rent, and it's fulfilling a need, especially for groups like the millennial generation that has outgrown apartment living and is looking for more space and more privacy, and their families are growing. So, build to rent really fills a nice need there.
Is there any conversion that you later on look at from the Mill Creek side to look at a property and say, okay, this was built to rent, And now, at some point, we would like to list this as a unit or a property for sale. And what is the thinking that goes into that calculus?
That is not our intention. We're, built to hold. So we're building and we're teaming up with institutional investors who want to be in built to rent because it is viewed positively because it's actually expanding the housing stock in the U.S. and it's fulfilling a need. So not our intention. Most of our investors are long-term holders there, and to the extent they were not, we would probably look to see if we could somehow recapitalize and hold the property ourselves.
What are the hot markets that are seeing the most growth in build to rent?
Well, nationally, most of those are in the Sunbelt markets, and there's reasons for that because you have rapid employment and population growth, and they're more friendly towards businesses, and so there's fewer barriers to entry. So, the hot markets for us are in the Sun Belt. So, working from west to east, that's Arizona, Denver, Dallas, Fort Worth, Austin, Tampa, Orlando, Atlanta, Charlotte, Raleigh, Durham.
And when you're starting these construction projects as well and kind of breaking ground on a new community, the financing that you would be looking to kind of take on in order to get that started, where are you seeing new partners come in and want to provide that capital and that upfront to make sure that you can break ground and begin and complete construction?
Yeah, no, we're that's a great question. We don't close on land until we have all the entitlements in place. Most of our deals, all of our deals actually, we're doing with institutional investors. And I'm sorry, Brad, what was the second part of that question?
No, I think you were getting at it with regard to what the construction costs are and where you're saying, okay, this is. Yeah.
So what's, what the investor is requiring has gone up. The untrended yield on cost, so an unlevered measure, is now in the 6.75 to 7% range. And that's up 100 and 125 basis points from its previous peak. If you look at our average cost of what we're building, it tends to be around $350,000 per home. Things definitely have become more challenging with the rise in interest rates because we finance these with 55% debt, 45% equity, and that construction debt has been somewhere around 300 over SOFR, so putting you, in the 8+ range. The expectations are that interest rates will come down, and at completion, stabilization will recapitalize to a more attractive fixed rate permanent debt.
Really, really fascinating operation. David Reynolds, Mill Creek President of Investment Management. David, thanks so much for taking the time here today. Really appreciate it.
Yeah, thanks for having me. Hopefully I answered all your questions.
You did, and you did well, David. Appreciate it. Thanks. Let's do a final quick check of the markets here to end out this 11 a.m. hour. We're taking a look at the Dow, the S&P 500, and the Nasdaq. You're seeing still green across the screen right now and moving a little bit higher from the last time we checked in on it. The Dow up by about 0.25%, S&P 500 fractional gains, 0.4% there, and the Nasdaq Composite, that's up about the same on a percentage basis, 0.4%. Well, that's it for now. You've been watching Wealth on Yahoo Finance. I'm Brad Smith. We'll see you tomorrow at 11 a.m.
Are you frustrated about the housing market? You're not alone. And don't worry, we'll show you options like this Toll Brothers new home on Long Island, New York. This home hasn't even been listed yet. I bet you're wondering, can I even afford a home like this? Not a problem. Home builders have been offering incentives like price cuts to attract buyers. Join us for Yahoo Finance's Real Estate, the New Reality. A special where we talk with experts, including real estate brokers, as they navigate these new commission fee rules. We'll also tap into commercial real estate. Are cities evolving and addressing the housing shortage? Tune into Yahoo Finance Live all week long.